Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Today, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iveson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg The Open with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, a group of almost 1,000 tech companies has warned the UK risks falling behind in key technologies like AI and semiconductor. That's if the government does not urgently overhaul its policies and regulations. Well, lobby group Tech UK has called Britain a broken economy for growing startups. But there are tech companies that are actually still choosing the UK, like HR and payment software startup Rippling. Now, to find out why, we're joined by Parker Conrad, the Chief Executive Officer and co-founder of Rippling. Parker, thank you for joining us.
Thanks for having me.
This is exciting because, A, you raised quite a lot of money quite quickly, and this is to basically kickstart something in the UK that would be what a template for the way that HR manages things elsewhere.
I think that's right. Yeah, Rippling's an all-in-one system for payroll and HR and a few other things as well. And we're launching this week into the UK.
And so what happens if it's successful in the UK? I mean, do you see the UK as a template of what could happen in other European countries or even other jurisdictions?
Yeah, I think that's right. I mean, we think of the UK as sort of the best market for tech early adopters in Europe, and this could be the first step for us.
Yeah, and we've seen a number of big Wall Street firms, right, trying to do the same with bank cards. How long do you have the UK experiment to see whether it works and you roll it out in other European countries?
We'll see. I mean, it depends how well it goes. I think it could be quite quick. I think we're establishing sort of a presence in a bunch of different places.
Talk to me a little bit about, first of all, the problem with legacy payroll providers. Like, you own this market, certainly in the US. Like, why was there an entry point?
Yeah, I think one of the things you see in the UK market in particular is that you have a lot of different systems that need to be brought together to run payroll. You have usually an HRIS system, something for annual leaves, for pensions, for payroll. You've got to send files over to your bank. There's a lot of manual process going back and forth with this. What we do with Rippling is we say, hey, look, it makes no sense to have all these things be separate. If you bring them all together into one system, you just go in, it looks good, you click a button to click submit, and the money's on its way to your employees. Rippling's a 2,000-person company. I personally run payroll for our company across employees in a dozen different countries for our business, and it makes it really easy for all of our customers to do the same.
So how much are you expecting to grow? I mean, I don't know the market share in the UK or whether you even have a global figure.
We, Rippling is, as a business, we're roughly doubling year over year. In the UK, we've got a core group of about 15 to 20 people that are working in our office here just to kind of kick things off, and we expect to sort of triple or quadruple that team this year.
Parker, I mean, some of the figures around rippling are quite incredible. So you raised $500 million in less than 12 hours. You have a valuation, we understand, of just over $11 billion. And this is also because SVB collapsed. Talk us through the linkage.
Yeah, so what happened is in the United States, the way things work is that companies actually send payroll funds to their payroll company a few days ahead of when their employees get paid. We used SVB as the sort of rails for a lot of our banking in the US for our customers. And so when the bank collapsed, I woke up on a Friday morning and discovered unexpectedly that all of the funds that we were paying out to our clients' employees were still stuck at the bank in receivership. We made a very difficult decision in order to make sure that people got paid. We wired about $130 million of our own capital to JP Morgan Chase and essentially double paid the payroll to make sure that people got paid that day. And as part of that process, we also kicked off a quick fundraising round to sort of make sure that we had enough capital to be able to do that.
I mean, it's a big gamble if then they hadn't guaranteed what happened at SVB.
Yeah, that's right. I mean, when we decided to do that on Friday, it wasn't totally clear what was going to happen. By the end of the weekend, of course, the FDIC stepped in and all the funds were released on Monday morning.
Yeah, I feel like that weekend is tattooed in my brain, like many of us.
Yeah, it was a stressful time.
I mean, did it make the strategy is basically you're I guess trying to do good. Does it make customers more loyal when you take difficult decisions? You could have lost $100 million. Is that fair to say?
Well, I mean, we thought it was just there were hundreds of thousands of, in this case, Americans that were expecting to be paid, and we felt very strongly that our clients had sent us this money, and we were going to make sure that it got delivered to their employees.
So, Parker, by now, I guess, entering the UK market, do you think it changes this prospect for UK businesses, especially the small and medium enterprises that are really the backbone of the UK economy?
Yeah, I think a lot of UK businesses spend, 5 or 6 days a month, even small businesses, dealing with payroll. And so I think we can take that and really dramatically cut that down. Like I said, I spend, probably just, a few minutes or just a few hours a month running payroll for our 2,000-person multinational company. And so I think we can really reduce the time and the administrative burden on businesses that's required from a lot of these processes.
Yeah, and it means that they're more, I mean, we talked about this, basically means, they can do more strategy, more of the important stuff that makes their company grow. After the UK, what's next? Is there a country or a region that you want to expand in?
I think for us, we're looking at sort of working with the EU market, but for right now, we're focused on the UK.
So again, this is a one-stop shop to look at HR, IT, and finance globally. Do you have to have conversation with the government, or no? It doesn't really. I mean, this is a private company. You don't have to get the go-ahead or anyone from regulation.
Well, it depends country by country. Okay. So, in the UK, for example, we work with the HMRC to make sure that we can file and pay taxes on behalf of our customers and help with that process. And country by country, there are sort of different processes to follow to sort of make sure that you're set up to work with the governments in those countries. And
again, do you need data centers for this, or how to process? How does it work?
Yeah, so we set up we set up infrastructure so that clients can choose where they want their data hosted, because obviously that's really critical when you're operating in these different markets for businesses to be able to have that choice. And
I imagine that changes, right, if you're a European-based company than if you're in the US because of rules.
Of course. Well, a lot of businesses, in the EU in particular, want to make sure that their data is hosted there.
Yeah. Okay, Parker, what a fabulous, interview. Thank you so much for making the time for coming on, and we'll get you back on in like 3-4 months to see how it's going.
Thank you very much.
Parker Conrad, Chief Executive Officer and co-founder of Rippling. Coming up, Prime Minister of Italy, Giorgia Meloni, faces a few challenges ahead, key among them reviving Italy's economy. We'll discuss that next, and this is Bloomberg. You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition of Francine Lacqua here in London. Now let's get straight to a Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Apple has unveiled its first new major product category since 2015. Its much anticipated Vision Pro mixed reality headset comes with a price tag of around $3,500. Meta's industry-leading headset sells for $1,000. Now, Bloomberg understands Indian education startup Baiju has elected not to make further payments on a $1.2 billion loan after a dispute with lenders. The move escalates a conflict that could jeopardize the future of one of India's highest flying startups. Baiju has been trying to strike a deal with creditors to restructure the loan while also seeking to list its tutoring unit next year. China's Evergrande's property unit has delivered a delay earnings report that may bring its shares closer to a resumption of trading. Evergrande Property Services Group reported a profit of just under $200 million for 2022. That's reversed a prior year loss but fell short of 2020's result. The stock of China's most indebted developer has been suspended for more than a year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, top of Prime Minister Giorgia Meloni's Italy First agenda is the creation of national champions in areas from energy to fashion and luxury, and a sovereign wealth fund to finance them. Now, for more on all of that, our Bloomberg Big Take Scoop, let's bring in Alessandra Migliaccio, our Western Europe economy reporter in Rome. Alessandra, thank you once again for joining us, and congratulations on a great Big Take. How is Meloni implementing her new vision for Italy?
Thank you, Francine. Thank you for having me. Well, Meloni is essentially putting all her people in very strategic posts. Some of that is good luck. She has the luck to be in power at a time when a lot of these posts are coming up. And so she can nominate people in very big companies. We're talking about things like Eni. Eni is one of Europe's and one of the world's biggest oil companies. Enel has assets all over the world. It's an energy company, particularly Latin America. There's Leonardo. It's a huge defense company. So they're very strategic companies, important all over the world. They make a lot of money. And she's putting people that she believes will continue her vision, even if the government happens to fall, which we know in Italy happens often. So it is really a strategic vision that will go on even after she's gone.
So what do investors think of this? If people are concerned about when she came to power because of her far-right, populism ideas, have they done a reversal on this?
Well, here's the thing. She's playing a very fine game, and so far it's working. I think essentially, internally, she's still that populist, anti-immigrant, anti-LGBTQ rights person, but more and more outside externally and from the economic point of view, she's very wise and she's being moderate. She is not, markets are taking it very well. She's not doing anything uncautious on the economy. She's being careful about debt, careful about deficit, which is a huge problem for Italy. And we can see that with the spread. The spread between Italian and German bonds has not really moved that much, and it's much lower than it was a year ago. So her strategy is working of this moderate stance outside the country.
What about her vision on China? It looks like she'll pull out of the Belt and Road. What does that mean for Italian business?
So this is a real problem for Meloni because she has this nationalist view, and part of her whole program is also she doesn't want to alienate the U.S. in any way. She wants to be a good ally. She wants to show she's playing the game and she's not an outsider. And so she wants to pull out of Belt and Road, but Italy has over 2,000 companies involved in China. They're heavily involved. You have companies like Fincantieri, the big shipbuilders. You have Brembo. They make brakes for Ferrari, for example. And they're very worried because it's happening really fast and they were very involved. So they may not have time, if Italy pulls out and China retaliates, to protect their businesses from what may happen.
All right, Alessandra, as always, thank you so much for joining us. Great reporting there on The Big Take with Alessandra Migliaccio, our Western European economy reporter in Rome. We're also getting some breaking news. We understand that German and Indian companies have been nearing a deal to build submarines in India. We'll, of course, get you more news on that. This is just breaking news, just crossing the Bloomberg terminal in the last 1 minute or so. Now, Bloomberg Surveillance Early Edition continues in the next hour. A full market roundup. This is Bloomberg.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called Red Wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The RBA surprises markets with a 25 basis point hike and says more tightening may be needed. The Aussie dollar jumps. Apple unveils its long-awaited mixed reality headset, but investors are skeptical of the eye-watering price tag. And the SEC sues Binance and the CEO, Changpeng Zhao, for allegedly breaking securities rules. The crypto exchange calls the complaint disappointing and misguided. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And Kriti, bit of softness in markets today, a bit of softness in the data stateside, particularly on services coming through yesterday.
Yeah, it all comes down to that question of, are we getting closer and closer to that recession that I think a lot of people have been predicting is just around the corner for 2 years now, Anna. But now as we get data like the services ISM stateside yesterday, this suggests, well, maybe that slowdown in the biggest part of the U.S. economy, well, it's coming way faster than we expected. And that really weighed on sentiment in yesterday's trading session, largely weighing on sentiment today as well. As you see, futures really down about 0.1%. And again, this is not a massive move to the downside, but given the context in the last couple of days, futures have kind of remained unchanged at this time. This is, I would say, a little bit more conviction in the idea that it is a little bit of a down day. You're seeing that as well when it comes to the bond market. The idea, again, that perhaps the Federal Reserve needs to be repriced. You're looking at a 2-year yield here that's down by about 2 basis points, 444 on that level. What's interesting here is that we're about a week away from the next Federal Reserve meeting, and we're here talking about whether or not the Fed needs to hit pause. I mean, that's what the market is pricing, but if you were starting to see a real slowdown, at what point does the market interpret that as a need to cut and therefore pushing the Federal Reserve? At least that's going to be the kind of conversation we have in the coming days as we get closer. As yields come down, it really influences the dollar as well, bringing that down. What's interesting to me, though, Anna, is just 24 hours ago, we were talking about this massive voluntary cut from OPEC, putting a floor under prices, and yet here we are again on NYMEX crude, testing that 70 level, down about 2.7% already. So what does that say in terms of the recessionary calls around the world? And speaking of those recessionary calls around the world, let's take a quick moment to look at what's happened overnight in Asia, because you saw a little bit of a mixed picture. You saw some real outperformance over in Japan. The Nikkei higher by almost 1% there. But the Hang Seng, the Chinese index, of course, unchanged, underperforming the broader gains you saw in the region. Worth mentioning, though, the real highlight was coming from the RBA, the Australian Central Bank. You are seeing strength in the Aussie dollar here after a surprise rate hike, as you mentioned at the top of the show. What does that say in terms of tackling inflation? Again, just a week away from the Federal Reserve meeting stateside. You are seeing strength in the Aussie dollar, higher by about 0.6%, as well as a little bit of a bump in the Aussie yield as well, Anna.
Yeah, really interesting, the RBA story, because even if there is no direct read across into the Fed or any other geography, there certainly had been, of course, this was a central bank that had been on hold and then starts to hike again. And so does that give us pause for thought when we come to think about central banks and our expectations there? This is the picture for European stocks then, on the back foot, down by 0.6%. Over in Italy, down by less than that in most of these markets, but modest weakness coming through, 0.5% lower on the London market. Healthcare providing one area of green, but most of the sectors are now in negative territory as we deteriorate a little bit as we go through this morning's session. One area of brightness has been the energy story, at least, one area of weight has been the energy story. Brent crude is down by 2.5%, and that is weighing on energy stocks, and we'll look for this to be replicated stateside perhaps. But after that initial bounce in response to the Saudi action, as Kriti, you pointed out, we're now seeing weakness in the oil price, down by 2.4% on Brent crude, and that is having an impact on those stocks that make their money from Oil. Speaking of commodities, natural gas futures really in focus here when it comes to Europe. And we're not seeing much movement in today's market. But yesterday we saw a really big jump, a 20% jump. This is like months, you know, we knew and got used to during the invasion of Ukraine, the initial invasion of Ukraine. Of course, war ongoing there in dramatic fashion. But now we saw a 20% jump in gas prices just yesterday in the UK and on the European benchmark. A lot of people asking questions about how tight that market gets, whether LNG is tempted to Asia rather than into Europe. Here's a couple of currencies I put in because we've had some data out. The pound is interesting, 124.20, pretty flat really. But interesting construction data coming out. So the overall construction picture not that bad, but that was lifted by commercial and some of the civil engineering projects. On the home building front, we're down to levels of home building we haven't seen since 2009 as rates rise. The euro at 106.99, so flirting once again with that 107 or just below the 107 level. We heard Christine Lagarde at the ECB reasserting those expectations in markets. It seems that we'll get more hikes coming through from the ECB, including next week. But then look at inflation expectations. They have softened, and that is, though, quite a volatile number. Lots to discuss with our guests then, Kriti.
Yeah, absolutely. And at the top of that list, perhaps that surprise decision from Australia that seems to be having a kind of little pause for thought impact on investors around the world at the moment. More on that, which unexpectedly raised its key interest rate to the highest level since April of 2012 and kept the door open to further hikes. Joining us now to break it all down, Bloomberg Markets reporter Justina Lee. Justina, look, you cover central banks from around the world. What is kind of the thinking here in Australia, a country that noticeably has been having a hard time adopting the tighter policy regime, but also really tackling inflation?
I think the Australian central bank is finding itself in the shoes that a lot of monetary policymakers are in right now, which is that headline CPI has kind of crept down a little bit, but at the end of the day, it still seems very far from the target of around 2 to 3%. And headline CPI and core CPI is still like stickily high. And so putting together all of these things, I think that's why they decided to surprise markets with a rate hike and even signaled further tightening. Now, looking forward, economists are a bit split right now. Some see maybe, more hikes coming forward, and some are kind of expecting a pause anyway, because people are kind of expecting to see a bit of a slowdown in Australian growth, which should help curb further price increases as well.
And they did certainly reference the wages story, which looked quite standout in terms of the wages that are being agreed in Australia. Let me ask you, whilst we have you, Justina, about what's going on in China as well. China asking big banks to cut their deposit rates, again, to boost the economy. The support for the property sector in particular in China, very much mentioned last week by regulators and also talked about in markets today.
Yeah, exactly. I mean, that's like a completely different path from the rest of the world. But I think what China has experienced is kind of disappointment in what that post-COVID reopening boost has proven to be. And so now we've seen worsening data across, retail sales, industrial profits, the property sector. And what this move does is, it encourages banks to cut their deposit rates, which hopefully will mean they get to lower their lending rate and get money growth going again. But I think, in terms of the currency, what we have seen is further weakness in the yuan. And that's something that's, totally to be expected, given that China's going in the opposite direction from, especially the Fed right now.
Yeah, the monetary policy conversation stands in stark contrast, doesn't it, Justina? Thank you very much. Thanks for joining us. Bloomberg's Justina Lee with reflections on some of those big macro themes this morning. Let's get to the corporate agenda. Apple unveiled its long-awaited mixed reality headset at its annual Worldwide Developers Conference with a hefty price tag of $3,499. CEO Tim Cook spoke about the new product yesterday.
So in the same way that Mac introduced us to personal computing and iPhone introduced us to mobile computing, Apple Vision Pro will introduce us to spatial computing. This marks the beginning of a journey that will bring a new dimension to powerful personal technology.
So the future is spatial. Alex Webb of Bloomberg Quick Take joins us with reflections on this latest offering then from Apple. And we saw the stock stumble a little bit as they announced that price tag. Is that because the market worries that not enough individuals will pay, or that actually it isn't aimed at a mass market.
Yeah, it was interesting. There were two dips to the share price over the course of the sort of 2-hour presentation. The first one came when Apple showed the first use case that it saw, at least for this product, and it was businesses. Investors took that to mean this is a product they're going to target firstly at the enterprise. You can also partly infer that from the device's name. It's the Vision Pro, in the same way that we have the iPhone Pro. You can therefore perhaps suspect that sometime later down the line there'll be a non-Pro version that's a little bit cheaper, and that gets to the second idea. The price point, $3,500, $3,499. It had been reported it was going to be in the $3,000 range, so it's a little bit more expensive than that. That signals to the market this is not likely to be a mass market product. Mark Gurman, our colleague, has reported in the first year, which will be next year, not this one, Apple perhaps only expects to sell 900,000 units. It's quite a lot for a new product category, considerably less than the iPhone.
Well, during this unveiling, Alex, they also talked about some of their other products, like a new version of their MacBook, for example. To me, that immediately signals what the ripple effects are for the chip sector, which brings me to another story overnight. TSMC, specifically lowering their CapEx as a result of perhaps the chip demand that's slowing as well. What can you tell us about that part of the business?
Yeah, they'd already given a range of how much they expect to spend building out new capacity. It's going to be $32 billion, sort of the lower end of that range. The readings people take away from that is that they're not expecting a massive resurgence in demand, not least for laptops, but also for smartphones, which in the case of Apple is the lion's share of its business. Still, there had been some hope that the demand for AI chips that help with AI, might drive some demand at TSMC. It does make the chips for NVIDIA, the sort of equity star of the past few weeks, but is still a far smaller part of its business than what it does in making smartphones. So they're not going to be benefiting from that just yet. They may do in the years ahead.
Let me get your thoughts on crypto while we have you, Alex. The SEC's Binance lawsuit then, no doubt striking fear into many with exposure to the crypto space. Accusations of mishandling customer funds, misleading investors and regulators, breaking securities rules, all denied by Binance, but a long battle ahead, perhaps.
Yes, and it's certainly sent a further chill through the crypto sector. One person in the Bloomberg story said that it was a continuation of the crypto nuclear winter. Key thing here really is whether these are considered to be securities. The SEC is now saying that they identified 12 things that are traded on Binance's exchange that it thinks are securities. Therefore, if it's in breach of security law, that's a big problem. Leads to more regulation. It's a big problem as far as Binance is concerned. Leads to more regulation and is not something that crypto investors look on too positively.
Alex, thanks very much. Alex Webb joining us there with a number of tech themes and the crypto news flow. And if you're interested in that story on Binance, then catch Bloomberg Crypto. That is today at 1 p.m. New York time, 6 p.m. in London, the weekly show that covers the people, transactions and technology shaping the world of decentralized finance. Coming up on this program, Italy's first female prime minister looking to drive change in the economy, starting with corporate Italy. That's our big take story. We'll get full analysis from Italy for you next. And the narrow breadth in stocks looks untenable. That is the view of Aberdeen's James Attey. More on that still ahead. Plus, we'll be speaking to Liz Martin, senior economist at HSBC. Lots to discuss in terms of the UK construction sector, the European inflation expectations, and rate hikes still to come. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that that pandemic will be behind us in some way, do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Today, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iveson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg, The Open, with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. The top of Prime Minister Giorgia Meloni's Italy First agenda is the creation of national champions in areas from energy to fashion and luxury, and the launch of a sovereign wealth fund to finance them all. For more on today's Bloomberg's Big Take, let's bring in Alessandra Migliaccio, who co-wrote the story. Alessandra, when I think Italy, I don't immediately think big corporate hub, and yet that's exactly what the Prime Minister seems to be shooting for here. How is that actually unfolding, given Italy's ties to Russia?
Well, you have a very good point, and it is what she's shooting for. She's a nationalist. She's shooting for national champions. And, you're right. It's not what you think about, but Italy is a G7 country. It has a very big economy. And actually, did you know the biggest export is manufacturing and metal parts? It is not, food and wine and what you may think. So she's shooting for national champions. She thinks that exactly Italy has the wrong image. More could be done. Examples. ENI is a state-run company that she has put her people into. ENI is one of the world's biggest oil companies. Then you have Enel. Enel is a very, very big energy company, has huge assets in Latin America there as well. It's partly state-run, and she's putting her people in. So she's doing that just for a number of companies, and she's also fortunate because, it comes up every 3 years, and she was elected just when the nominations came up. That means that even if this government should fall, which, as you know, in Italy sometimes happens, her people will remain. So her vision can go on for several years, and that's really her goal.
Okay, so she's looking to reshape corporate Italy. Good morning, Alessandra. What do investors think of this? Because there had been concern amongst the investor community that she came from a far-right and populist politics, but has she shaped up to be what investors were expecting?
Well, from the investor's point of view, she has, because what she's doing is she's playing this very fine game, whereas internally she's still the populist, she's still anti-immigrant, she's still, not for LGBTQ rights. There's still a lot of that. But outside, as far as the economy is concerned, she's very moderate. You have the spread between Italian and German bonds that is really very narrow compared to the past. It's much lower than it was last year. It's well below 200 basis points. So that's a sign that investors have seen that she's being careful on the deficit. She's being careful about debt. She's not spending wildly. And she is, pushing this nationalist vision, but with a moderate stance. She's being careful, especially not to alienate her allies, which is key.
And speaking of not alienating her allies, one of those key allies is China at the end of the day. Talk to us about Italy's involvement with the Belt and Road Initiative. How's that worked in the past? Where might it go in the future?
Well, right, here's the thing. So it's an ally, it's an important ally because Italy is one of the few countries who actually signed this Belt and Road. But then at the same time now, Meloni wants to be a team player with her other peers in Europe and especially with the US. She wants to befriend the US. I mean, she has, but she wants to keep that going. So now she has to move away from China. She's hinted it Her ministers have more than hinted it, and she's moving away from this Belt and Road deal. What does that mean? Well, it's not great news for companies, and so she's getting a lot of pressure from Italian companies because there are more than 2,000 Italian companies in China right now. Some of them are very big. Fincantieri is a huge shipbuilder. Brembo, for example, makes brakes for Ferrari. They're going to be in real trouble if China decides to retaliate because Italy is pulling out.
Alessandra, thank you very much. Alessandra Migliaccio in Rome for us. Thank you for bringing us the Big Take story. And you can find all of the Big Take stories on Bloomberg.com and by searching NI Big Take Go on the Bloomberg terminal. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping up to date with news from around the world, here's the first word. Morgan Stanley is planning to move to a new office in Singapore as it looks to expand its presence in Asia. Bloomberg has learned the company is in advanced talks to take over 5 floors of towers currently under construction. A boom in private banking, family offices, and other financial services during the pandemic has bolstered demand for swanky offices in Singapore's business district. Jamie Dimon will be on Capitol Hill today. Bloomberg has learned the JP Morgan Chase CEO will meet privately with a group of moderate House Democrats to talk about banking and the U.S. economy. The closed-door lunch takes place as Dimon has been urged to enter the 2024 presidential race despite his protest that he does not plan to run. The Biden administration says military interception maneuvers by Chinese ships and planes suggest a growing aggressiveness from Beijing's national security. The council spokesman John Kirby says these actions risk an accident that could result in injury. The Pentagon says a Chinese warship last week crossed in front of a U.S. Navy vessel in the Taiwan Strait at a distance of less than 150 meters.
It won't be long before somebody gets hurt. That's the concern with these unsafe and unprofessional intercepts. They can lead to misunderstandings. They can lead to miscalculations. When you have pieces of metal that size, whether it's in the air or on the sea, and they're operating that close together, it wouldn't take much.
Ukraine says Russian forces have blown up a giant dam in the country's south. The blast has unleashed a torrent of water, putting 10 villages and parts of Kherson at risk of flooding. Residents are being told to prepare to evacuate. President Vladimir Zelensky summoned an urgent meeting of Ukraine's National Security and Defense Council to discuss the attack. And devastating images coming out of Ukraine, but interesting timing here as we hear reports of a potential counteroffensive from Ukraine as well.
Yeah, absolutely. The imagery of all that floodwater certainly makes you concerned for the people who are involved, front and foremost. And here we see, for our radio audience, just showing some of those images here on screen right now. This is a humanitarian story and very much, of course, part of the war narrative. Crop prices jumped on this, though, just to add in the markets angle, even though there doesn't seem to be much threat to crops directly in the path of this water, but certainly that was the risk from a market perspective. But to your wider point, Chrissy, this does certainly seem to be coming at a time where everyone was braced for a spring or summer offensive. Counter-insurgency coming from Ukraine. Of course, the Ukrainians have told us they won't make it necessarily very obvious when that is going to start. It won't come with a big announcement, but this uptick in violence that we are seeing in the conflict right now is that part of that insurgency, that fight back from Ukraine.
Yeah, and it's interesting what kind of international support it's gotten as well. We were just talking with our reporter over in Italy as well, talking about Giorgia Meloni and her stance, and simply her unwavering support on the Ukrainian story has actually lent her quite a bit of political capital from around the world. And it feels like as we talk about this counteroffensive, it's really seeping more and more into the conversation in Europe, in the United States, even in Asia, about where you stand and how that dictates the future of international relations as well. One of the key stories that caught my eye over the last few weeks, Anna, is this multi-billion-dollar plan out of Europe to continue the financing of Ukraine. So certainly something to watch on that front.
Absolutely. We'll be back to the macro themes shortly. Coming up, we'll talk to Aberdeen's James Assey on why he doesn't see a soft landing narrative dying so easily. In fact, he's talking about narrative tennis, just a nice way to encapsulate those looking at forward-looking indicators, those looking at backward-looking data, and thinking about how the stances of those two camps play out from here. More on the macro themes shortly. This is Bloomberg.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The RBA surprises markets with a 25 basis point hike and says more tightening may be needed. The Aussie dollar jumps. And Apple unveils its long-awaited mixed reality headset, but investors are skeptical of the eye-watering price tag. And the SEC sues Binance and CEO Changpeng Zhao for allegedly breaking securities rules. The crypto exchange calls the complaint disappointing and misguided. I'm Krita Gupta in New York with Anna Edwards in London. Anna, even though we have all of these kind of pieces of news on the micro front, the macro still seems to be around two words: inflation and recession.
Yeah, absolutely. And people's expectations around those two things moving around a little bit. Certainly when we saw that data, the weakness of that services ISM data coming out of the US certainly gave people a lot to think about after the strength of the data on Friday, certainly on the job creation side. This is the picture for European stocks, then pretty flat to negative on European stocks and not going anywhere very fast. Healthcare, one sector that's moving higher, but to the downside, we see the heavily weighted energy names under pressure as a result of a bit of weakness coming through in the oil price. Just what kind of floor have the Saudis put underneath Brent? We'll certainly continue to ask those questions. This is the natural gas price, and we put this in because it was up by more than 20% yesterday. This is the benchmark that we showed often at the start of the invasion of Ukraine, and it was where we were seeing a lot of the concern about gas supply in Europe being reflected. Yesterday, we saw that big jump for similar reasons, talking about issues around tightness in the market and whether LNG was going to be incentivized to go to Asia instead of staying here in Europe. It might be summer now, but of course, thoughts in that market always turning to the next winter. So we are seeing some pullback, but from elevated levels on the gas price. The pound is at 124.09, down by 0.2%. Interesting construction story developing here. The PMI for that particular part of the economy flattered by some civil engineering projects. But on the house building side, Chrissy, the lowest level of construction we're seeing since 2009. Of course, if you exclude, the pandemic, that crucially also saw weakness in the construction space. And the euro is just down 0.1% or so, just under the 1.07 mark. Are we expecting another couple of interest rate hikes from the ECB? We heard from Christine Lagarde yesterday. She was talking about how the inflation struggle is still on. It's still active here in Europe. So that seems to be the market's expectation after hearing from her. But we are mindful of inflation expectations more broadly from the European people. And we are seeing some downward pressure there, although that is a very volatile set of data. Chrissy, what do you see in the US?
Yeah, well, that downward pressure, that flat to negative sentiment that you were just outlining, Anna, certainly fueling perhaps the equities a little bit to the downside, although not really having that major conviction or sell-off kind of tone just yet. All of that could change in just a few hours. Futures trading about 42.77 on the contract here. down about 0.1%. We'll call it that for our radio audience. The two-year yield, though, to me is what's more interesting because as we see the kind of Fed get repriced, the idea of whether they need to go hard on inflation coming off those really hot payrolls numbers or perhaps take a step back and perhaps hit that pause button with the market is pricing in off again the ISM data you mentioned, Anna. That kind of tug of war between the narratives is really hitting the two-year yield, kind of going back and forth, re-entering that trading range. 444 on that, although down about 2 basis points. So seeing a little bit of a bid into the front end of the curve. As the yields come down, though, the dollar follows. So that bias that you are seeing, that weakness perhaps reflected in the greenback as well. But nothing I would really write home about just yet because, again, everything could change at those opening bells. NYMEX crude is what's interesting to me, though, because as we talk about inflation, it's the recession fears that are kind of creeping into the market. You really see that show up in the commodity space. A 70 handle on NYMEX crude already down 2%.
Okay, let's get into a markets conversation then, Critty. We're joined by James Assey, Investment Director at Aberdeen. James, very nice to have you with us today on Bloomberg TV. Let me start by asking about what you call narrative tennis. So the idea that we've got a couple of different competing narratives, at least 2, in the market. Maybe there are other balls on the court as well. But how do you find that this is resolved? In which direction do you think we resolve this?
As you say, big picture, there are 2 narratives, but when you scratch beneath the surface, that there are definitely more. And a sort of popular and very simplistic macro framework is a kind of quadrant approach, and you've got growth on one axis and inflation on the other, and whether growth is high and rising or sort of decelerating, and inflation likewise tells you something about the likely environment for macro investing. I reckon in the last 6 months, we've spent time in each of those quadrants, stagflation, recession or no recession, inflation or deflation. And the data really has been volatile and inconsistent enough to support each of those narratives at a certain stage. And then globally and regionally, we've seen likewise, Europe and UK expected to have severe recessions because of energy prices, flipping around and suddenly then becoming the sort of pro-cyclical investment of choice. And more recently, because China has slowed, Germany seems to be in technical recession, we've gone back again. Realistically, taking a big step back and trying to look at this from the highest level possible, it still appears to me everywhere that the data is trending down with a lot of volatility, but trending down. And the most recent data we had out of the US service sector really didn't look great, considering that has carried the bulk of the burden in recent months for growth generation. So my base case is still that the monetary tightening into a highly levered system that we have seen is ultimately taking us towards recession.
Okay, so that's the interest rates and what they're doing. Thinking of this like a tennis game, I mean, it almost seems as if we got to match point and then have to wait to play that point another time. In yesterday's session where we saw the S&P nearly into bull market territory then, James. What are your thoughts on whether this really is going to be a bull market or where stocks more broadly head from here? Morgan Stanley suggesting that the narrowness of this rally means, driven by moves in the dollar and the AI frenzy, the narrowness of this rally means that this isn't really what bull markets are made of.
No, exactly. I think a lot of people have observed and made that comment that normally when you start a new bull market, leadership changes and B, it broadens. What we've seen here is basically the same very narrow set of mega cap tech stocks leading this bounce in the same way that they led the prior bull market. That's unusual. I think it's fair to say lots of things we're seeing are unusual and historically unprecedented or without precedent for quite some time. So it's difficult for me to say it can't be true. Ultimately, though, again, I think if recession is the likely outcome, it would be highly unlikely that we would start a new bull market while the Fed was still tightening policy, and indeed where 5 stocks basically do all of the work. All of that tells me that this is still a bear market rally, a painful one for bears and shorts. But ultimately, the economic outturns will dictate where the broad indices head next. And I think as we move into the second half, that's going to be lower.
But James, let me push back on that idea, though. Why is leadership by a handful of stocks, similar to the leadership we saw in the last bull market, such a bad thing, given that the last bull market lasted 10 years or so and has significantly contributed to portfolios around the world, given except this time there's actual real money behind cloud, AI infrastructure, things that have really been accelerated by the pandemic. Why is it a bad thing to have such concentrated gains, given perhaps it's justified by the fundamentals?
Sure, yeah. I mean, it's not to say it's good or bad, Critty. It is just to say that historically it's anomalous. We don't tend to see a sort of new bear market beginning with such narrow leadership, which is identical almost to the prior bull market. Again, that's not to say it can't happen, but when it comes to the fundamentals, I think one of the things that's been easily jettisoned over the last several years, largely because central banks have changed the nature of the game, is that investing is ultimately about value. It's not about just making a call on where earnings, where the economy are headed, but it's understanding what's discounted by the markets and investing on the basis of where there is value in doing so. And I think Amazon, a company which has been around for 3 decades, is highly mature and has seen rapid earnings growth from its non-core business, which is to say retail really doesn't make money now, and AWS has been an earnings machine. For it to be trading off a price earnings ratio of 114 suggests to me that maybe investors at this stage are overpaying for what is a high quality company. The examples that people always give, and I think they are highly valid, are things like Cisco and Sun Microsystems. You go back to 1999-2000, and they were priced for the sort of growth that they could not on balance achieve, certainly not while still seeing appreciation in their share price. And if you go back over that period, Cisco's annualized return is something around 0 to -1%. It's not a bad company. It wasn't a bad company. The narrative was absolutely correct, but the value just wasn't there as an investment.
It's an interesting point to make at a time when valuations in general are kind of being questioned as whether or not they should even be a factor. I want to bring to you a quote here from some of the strategists over at Citi, talking about kind of what you're talking about, perhaps with the opposite argument. With further support, they write, from the first quarter 2023 earnings and the uncertain macro environment, we believe the rotation from value to growth may continue. The potential Fed rate skip this month and cautious relative positioning in the equity market are tailwinds to growth performance as well. They're talking about that rotation to growth kind of coming in this environment of decelerating economic growth specifically. But argue the opposite for us here, James. Talk to us about the tailwinds in the value trade.
I mean, fundamentally, no, I'm not the opposite. I sort of understand the point that they're making, essentially, is that growth stocks have been seen as defensive in the sense that they've behaved a bit like duration because they've got this long profile of rising earnings revenue. The discount factor tends to be a bigger driver of current share price performance. So in an environment of falling yields, they should perform better than less sort of duration sensitive stocks, but also because recent history has said that a lot of these companies have been able to generate solid earnings growth almost regardless of economic outcomes. So if we are headed into a period of rocky economic performance, potentially disinflation, lower yields, lower Fed policy rates, all of that looks like a tailwind for growth. My hesitation is that, again, they are incredibly expensive. I would argue that they have already discounted a lot of the positives there, but they haven't really discounted a genuine economic recession. And I think some of these companies may see their earnings, their revenues being a bit more cyclically sensitive than is being priced. But this market has proven that momentum is such a powerful driver that trying to express that in the short term, can be a losing strategy. On the value side, it's more cyclical, but it's cheaper.
James, I just wonder if we are due a pullback in tech names then, I wonder how severe that becomes. I talked to Newton Investment Management earlier on, and they were asking themselves whether this is like 1999, and you alluded to that period earlier, and we all know what happened straight after that with the excitement over the dot-com boom. But they also wonder whether it could be 1994 and we're more at the foothills of the excitement. What are your thoughts?
I mean, I certainly hope it's not 1994 from a bond market perspective, because the Fed policy changes in 94 led to some serious losses. And I'm sure the Mexicans hope it's not 1994 because that really ended with them having the tequila crisis. Yeah, historical analogs by their very definition are a bit tricksy. I do think there are a lot of parallels to 1999, but I don't think the extreme of valuation broadly is quite as bad. But I think the leadership is much more narrow. But it's in businesses that I think we understand better, that are less speculative in terms of the nature of those businesses. So I'm not sure there's an exact parallel between either of those two historical analogs. Again, apologies for sort of being highly repetitive here, but I'm just going to fall back on the economics of the situation. And I think that will ultimately dictate whether I am right or whether I am wrong. If the economy avoids recession, if we manage to find some sort of equilibrium, stable equilibrium with low unemployment, and we can generate growth from these new productivity enhancing businesses, even if that growth, by the way, is not particularly well shared socially, then potentially the equity market is not going to go anywhere near those lows from October last year. Again, I would be shocked if economies manage to avoid recessions, given the sort of wealth of headwinds that they continue to face.
Yes. Okay, James, really good to get your thoughts. Aberdeen's James Athy, thanks very much for joining us. Coming up on the programme, we'll get back to some other macro themes across Europe. Liz Martins joins us, senior economist at HSBC. That conversation next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Moment news breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
Price pressures overall remain strong. Inflation, excluding energy and food that I have just mentioned, declined to 5.3% in May from 5.6% in April. That's what we call core inflation. Upside pressures on both headline and core inflation are still coming from the pass-through of past energy costs increases and supply bottlenecks.
ECB President Christine Lagarde, of course, reiterating yesterday that rates will rise further to regain control of prices. Let's talk about the European economy then. Liz Martins joins us, senior economist at HSBC. And Liz, in terms of the ECB, did we just cement expectations then on hearing those words from Christine Lagarde that we will get further hikes from the ECB and one of those will come next week?
Yeah, I think so. I mean, obviously, there was some welcome downside news in European inflation in the numbers that we got last week. Not universally, but for most of the major markets. But clearly, nobody came to the conclusion that inflation is dead in Europe. Actually, that number she mentioned, 5.3% core inflation, is still well above the comfort zone. So we do think that, yes, they hike next week, 25 basis points. I think that's quite consensus, according to the markets and economists. But also, we think they do it at least one more time afterwards and probably twice.
A month or so ago, we got German factory orders that fell by 10%. Bit of a shock to markets, much worse than expected. Today, we got a number that wasn't as big a miss to the downside, but it's certainly still in negative territory, Liz, for Germany. This a reminder, though, that as the challenges around energy continue in some places, there are still parts of the industrial complex in Europe that are up against it.
Absolutely. And I think the manufacturing sector in particular, you know, you look around Europe and globally as well, there's some real evidence of pressure here. I think probably when economists put in their forecasts for this industrial orders number for Germany, they probably thought, well, you know, we can assume there'll be a little bit of a rebound, 2-3%, and we didn't even get that. We got a further fallback. So really quite a downbeat release. But I think, you know, there's a few things going on with manufacturing globally. One is on the consumer goods side. Of course, consumers seem to have rotated their demand away from goods, the physical things that we buy in the shops and which people manufacture, and towards services, experiences, going out, having fun. That's a post-pandemic trend that shows no sign of slowing up. But the other thing is, of course, manufacturers don't just make consumer goods, they also make investment goods. And that maybe, I think, is starting to get hit by higher interest rates. So for a big manufacturing economy like Germany, yeah, of course, that's going to hurt.
Well, between the kind of COVID hangover that we have and, of course, the war in Ukraine as well, it's no secret that monetary policy is extremely challenging, and it feels like kind of inventing a new roadmap as we go. Liz, talk to us a little bit about the decision we got out of Australia overnight. Is there some sort of lesson that can be learned from Australia for the ECB, for the BOE, or more specifically, the Federal Reserve stateside?
Yeah, I think all these central banks that you mention are in the exact same quandary, aren't they? They'd love to be able to stop raising interest rates. They see economies slowing. They see labour markets starting to turn. But unfortunately, when they look at the core inflation data and the wage data, and particularly in Australia, we had a big hike, I think, in the minimum wage, which unsettled the forecasters over there in Australia, and that meant they just didn't feel they were able to stop tightening policy. So I think that, you know, the decision in Australia, of course, to hike by 25 basis points, it wasn't a huge surprise. I mean, we thought this was a very, very finely balanced meeting, but certainly it shows that as much as central banks would love to be able to stop tightening, broadly speaking, the data aren't allowing them to do so.
Liz, thanks very much. Thanks for joining us. Liz Martins of HSBC with some reflections on the global economy. And thinking of global economic forces, later today, Bloomberg's Jonathan Ferro hosts The Open, live from PIMCO's headquarters in Newport Beach, California, of course. He'll have exclusive conversations with the PIMCO CEO, Manny Roman, CIO, Dan Iverson, Global Economic Advisor, Richard Clariter, and other top executives. That is today at 9 a.m. Eastern Time. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Let's take a quick look at some of the stocks we're watching in pre-market trading stateside. Anna, top of everyone's mind seems to be the Apple story. We, of course, know that they released their new headset with a pretty hefty price tag. Those shares down about 0.6%. And Anna, I always wonder with Apple, who is their main competitor? They kind of dabble in a little bit of everything, but who are they really competing with?
Yeah, and a lot of focus on who are they really selling to in this particular case. If you're thinking of Vision Pro, as we were hearing from our colleague Alex Webb at the top of the program, a lot of focus on that price tag and the name Pro. And does that suggest it goes to a business audience, not quite so mass market? So that's an interesting one to reflect on. We're also focused on other tech themes today, not least of which the tech names that could be influenced by TSMC and the amount of capex it's going to do.
Yeah, it's interesting when we talk about just kind of this supply chain shortage turned a weakness, essentially. The idea here simply being that 2 years ago, there was a major kind of demand for supply chains. Now there seems to be a big glut of chips in particular. So Taiwan Semiconductor Manufacturing Company, TSMC, trading under TSM, by the way, the ADRs stateside higher by 0.2% as they talk about cutting back. Efficiency is a really key part of that story. What's interesting, though, is it's not having the ripple effect into other chip names like NVIDIA, like AMD, or even like Intel, for example, which again is interesting as Apple specifically. I'm going to connect it back to our previous story, Anna. Apple talking about making their in-house chips, something that again eliminates one of the major customers for the likes of Intel, NVIDIA, AMD, and of course TSMC.
Yeah, we have some negative movers on the technology space here, the likes of STMicro and Infineon, but not falling by a huge amount. Well, STMicro down by 1.6%. Also under pressure, though, in Europe, Chrissy. Certainly some of the energy names. This is by far and away the worst performing sector in Europe today. Energy stocks down by 1.5%. We have a big move downwards in the oil price itself, and it really does raise questions about just what kind of floor the Saudis have managed to put under oil. We're at 75.38 on Brent, and this is having an impact on expectations for oil companies as we get towards the start of trade in the US.
Exactly, and the spread, by the way, between Brent and NYMEX is certainly something to watch about. 70.81 stateside here, Anna. We're talking about it really testing that key 70 level. The read-through, though, when you see that weakness into NYMEX crude is simply more weakness in a lot of those names that are extra exposed to stateside production. I'm talking about Marathon Oil, Apache, Halliburton, all down to the tune of anywhere between 2.8% to 3.6%, that kind of range. And it really speaks to the idea that these are your three worst performers in the pre-market. So that energy weakness you're seeing in Europe, Anna, likely to kind of flood into the U.S. as we get into the opening bells.
Yeah, absolutely. A lot of focus then on energy stocks, focus on technology. Could we get in any of the sessions soon to a bull market, technically defined perhaps, up 20%, of course, on the S&P. That was the conversation yesterday, but we didn't manage to get there. We have to play that one on another occasion, perhaps. Is this not really a bull market? That's the view of Morgan Stanley. They said the narrowness of this, and we heard from James Athey over at Aberdeen. He was agreeing the narrowness of this does not make it to seem like a classic bull market. That is it for Early Edition. Surveillance is ahead. Wells Fargo's Anna Han amongst the guests on the program. This is Bloomberg.
forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
This is Bloomberg.
Markets, after they've run this much, they're always fragile, right? So you're looking for the next shoe to drop.
I do think the Fed is driving us towards a stall speed in this economy. And when you're at a stall speed, you become unstable.
The Fed is behind us. Maybe they hike once more, maybe they hike twice more, but that's it.
I think the Fed being on hold just should not be confused with job done.
The soft landing can't be ruled out. I don't think it's ever been able to been ruled out entirely.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Day 2 of waiting for a bull market. Good morning. Welcome back. Well, this is Bloomberg Surveillance from New York City. John is supposedly working in California on a beach somewhere. Tom is officially on vacation. You're looking out for day 2. You have me again. You also have Julian Emanuel, Chief Equity Derivatives and Quant Strategist at Evercore ISI for the hour. And this comes at a time when we are seeing this 20% potential gain on the S&P since the lows that we saw in October. Is this rally real?
We think it is, actually. We don't want to put the label bull market on it, okay? Because frankly, our base case is that sometime in the next 12 to 18 months, you're going to have a recession, which means you're going to have a sizable pullback. But this is a cyclical rally where we think the hallmark of the last week or so is a broadening of participation.
What is it about the labels? You don't want to call it a bull market. You don't want to call it a pause. You want to call it a skip. Like, why does it matter?
Well, it matters a lot. If you go back to the 2002 tech bubble burst bear market, you had several rallies of 40 and 50% in the NASDAQ before you made the final bottom. It is one of those things where rather than labeling, you have to think about how you want to think about the long term as either an individual investor or an active manager. And frankly, this is one of these times where those considerations are a bit different.
Is this a fun time?
It's a tough time, but look, at the end, we're happier when equities go up, I think.
We're seeing also a lot of potential risks on sort of a bigger picture scale, whether it's what we saw over in Ukraine with that dam bursting and what it's doing, some of these concerns about an escalating war there, or if it's ratcheting up of tensions in China, between the U.S. and China. How much are you looking at potential tail risks, or do you think that that's what's dampened some of the valuations at this point that's sort of set up for what you're talking about?
It's definitely dampened the valuations. And this, again, the period we believe we're entering is one of those times where, despite those risks, we do think we're going to see a little bit of multiple expansion, which is a bit counterintuitive. But frankly, what it does, and again, going back to our options expertise, the VIX with a 14 handle is absolutely fabulous in terms of protecting either downside risk or for some who are underperforming and may get pulled into a chase, upside risks.
So we're kind of bearing the lead here. On Sunday, you made a pretty big move. You upgraded, you increased your expectation for the S&P to 4450, and potentially you might see that as soon as July. Explain.
That's the hallmark of a momentum market. And I think, look, clearly the NASDAQ has been in a momentum market essentially since the end of March. And for us, the last week or so is encouraging because the S&P broadly has joined with that in its clear move above the 4,200 level, which had been basically 6 or 7 months versus of resistance. We're actually starting to see a little bit of broadening into the small caps, which is very encouraging. But frankly, again, this is an environment where the momentum takes on a life of its own. And that's also a function of the fact that if you look at it, sentiment, whether you're measuring it in terms of the stock market or the economy, or again, thinking about risk, is incredibly, incredibly poor. And yet at the same time, we're seeing data that says there's a chance that this recession gets pushed out. It keeps getting pushed out. It may end up getting pushed out to 24.
And right now we're seeing basically a range-bound market ahead of yet another day of quiet period for the Federal Reserve, but anything but when it comes to some of the international fluctuations. You see about 0.1% decline on the S&P 4275, still on the 4,300 watch. We didn't quite get there. Ongoing weakness over in the euro, but it's basically been around 106.8 for quite a while with a bit of a stronger dollar. And 10-year yields lower just a touch after those ISM services data that came out yesterday. Kind of disappointing, even though still in expansion. Crude a little bit off earlier lows. I want to note, I said John's on the beach. He's actually in Newport Beach. He's hosting the Open from PIMCO's headquarters, which is the reason why he ditched me, along with Tom. He'll be speaking with CEO Emmanuel Roman, CIO Dan Ivison, and former Fed Vice Chair Rich Clarida, who's their head economic consultant there at PIMCO. That's all coming up today, starting at 9 a.m. Eastern. Today, annual shareholder meetings will happen for Zillow, Urban Outfitters, Palantir, and Freeport-McMoRan. I say this because we actually saw some really interesting guidance out of Taiwan Semiconductor manufacturing company, basically downwardly revising some of their expectations. You're seeing shares off today. So it's sort of interesting to see some of the commentary coming out of these meetings at a time of such fluctuation. And today, I know that you love talking politics, Julian, so I really wanted to get you on this. Former New Jersey Governor Chris Christie is expected to jump into the race to become Republican candidate for president. He has been called in one New York Times article the Trump Slayer, people saying he has no chance to win, but his complete objective is to act as an attack dog on the stage in debates with the former President Trump. A pretty crowded field in the Republican race, potentially 12 candidates by July.
Well, you do wonder if Governor Christie is going to announce with a pair of Everlast boxing gloves on his hands.
Essentially, yes.
No question about it. Look, this is healthy. At least I think you can call it healthy. Let's see what happens. My question is, and hopefully we'll have someone help us answer it, is, who among the field, aside from Trump and DeSantis, could potentially rise to sort of create a three-way race? That's the big question.
And a lot of people are looking down to Virginia potentially for that, and we will get into that later. I do want to get to what we heard over in China, a recommendation that state-owned banks start to reduce their deposit rates to encourage lending and to increase their margins. Joining us now is Bloomberg's Tom McKenzie, who covered China for more than a decade. He's in London. Tom, what do you make of this? And also, what do you make of the fact that it's not a mandate, it's a recommendation?
Yeah, there's a fine line between a mandate and a recommendation when it comes to official policies out of Beijing when they lean on those state banks, of course. But it builds on what we were talking about last week, Lisa, around the measures being put in place, at least the proposals being discussed, according to Bloomberg reporting, to kind of shore up the real estate market. Now you have more piecemeal efforts to try and put a floor under the growth that has come through from China, less strong, of course, than many had expected. So leaning on the banks to reduce those deposit rates, it means that the banks can then look to lower the loan rates and provide more liquidity. We did see loans, new yuan loans, that credit impulse came through in the first quarter, but then it dropped on April. And clearly there was concern about the fact that there wasn't that traction going forward in terms of liquidity and that demand for loans. Households, businesses, they're shoring up their balance sheets. Households are paying down their mortgages. The question really is there the demand even as it becomes easier to take out a loan and to access that liquidity, is there really the demand to kind of tap into that and then support the economy?
On one hand, this is kind of stimulus light, and that's positive potentially for growth. On the other hand, this indicates that perhaps the Chinese Communist Party sees a bigger problem than they're letting on. Which is it?
Well, it's interesting. I was speaking to Hao Hong, who was formerly of BOCOM, a really respected strategist there, and he said, look, this seems to me like a government that's running out of ideas. Bloomberg Economics, they now view the chances of a benchmark rate cut, so for the 1-year and the 5-year medium-term lending facilities, they expect those to be reduced possibly as early as the middle of June. But there's a debate about that. Jones Lang LaSalle, economists there, say they actually think this action to lean on the banks to reduce deposit rates and therefore give them the scope to reduce loan rates, that probably pushes back a benchmark rate cut for the PBOC. By the way, for the context, they've cut just 50 basis points, just 0.5% since the start of the pandemic in 2020. So they do have that dry powder, but again, they have this massive debt pile, and there's that concern, of course, in terms of just adding to that if they go with a broad benchmark cut. But it's certainly something that now the Bloomberg economics team thinks is possibly likely mid-June.
Tom McKenzie, thank you so much, of Bloomberg, joining us from London. Julian Emanuel of Evercore ISI here with me for the hour. What do you make of what's going on in China and the fact that the growth is sort of running out of steam to such a degree? Do you feel like a lot of that story has been priced in and is really on the wane?
So we actually think that it's the bumpy path to a more sustainable number. It's not 6% or north of 6%, but it may settle in towards 5%. The issue here is a couple of things. First off, the way that China wants and will likely grow is unlike the last 20 years. You're making the transition to a domestic consumer-led economy. And the issue is that you've had a second COVID wave over the last 5 or 6 weeks. And it's hard to say, I think, right now, just how much of a dampening effect that has. But, in hearing the suggestion that banks reduce their rates, I'm reminded of that phrase, moral suasion, that I suspect you'll get a degree greater of moral suasion if things don't pick up. And obviously, the government is very, very in tune with the pulse.
The beatings will continue until morale improves, a bit of that. I mean, there is this question, though, going forward about how much of a tailwind or a headwind China will be. And as you talk about upgrading your forecast for U.S. equities, do you see U.S. as sort of being, I don't want to say a haven, but a new sort of spot of focus after everyone was looking international for the first half of the year?
Well, again, it is a mixed bag, because if you look at some of the consumer-focused names selling into China, they have sold off in the last month, even as the rest of the market has stabilized, and obviously parts of it have rallied quite strongly. And that tells you that it is an open question. The one thing that does seem clear is that this whole idea that China is going to be this very discrete reason for inflation to take another leg higher, that we don't subscribe to.
Every morning in your morning meetings, what do they seem like? Do people kind of sit around and they're like, well, it's the same kind of waiting game. We're not sure. But today we see more gains. I mean, is it sort of a momentum kind of discussion?
Well, it is. But, and again, when you think about it, Ed Hyman has been absolutely on the forefront of the view that inflation is going to come in faster than people expect. Now, the last month or two, it's been a little bit choppier, and we look ahead to next week, we think that's likely to be a sign.
We certainly saw that from the ECB and their consumer inflation release that they put out today, saying that expectations fell considerably. So how much do we get that with the CPI report coming out on Tuesday ahead of the Fed meeting on Wednesday, where they're expected to pause, skip, and then possibly do something later? We'll talk about that coming up at 7 a.m. as well with Greg Peters, co-CIO of PGIM Fixed Income. Julian Emanuel sticking with us. We are so glad to say.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Ukraine says Russian forces have blown up a giant dam in the country's south. Now, that blast has unleashed a deluge of water, putting 10 villages and parts of Kherson at risk of flooding. Residents are being told to prepare to evacuate. President Volodymyr Zelensky summoned an urgent meeting of Ukraine's National Security and Defense Council to discuss the attack. In France, unions are holding a fresh day of strikes against Emmanuel Macron's pension reform. It's the first nationwide protest in more than a month, and it will test whether the president has succeeded in getting much of the country to move on from the politically damaging fight. Macron has faced down months of protests and strikes. He angered many when he enacted the legislation without a full vote in Parliament. Consumer expectations for Eurozone inflation eased significantly in April, giving the European Central Bank reason to end its run of interest rate hikes this summer. According to its monthly survey, expectations for the next 12 months fell to 4.1% from 5% in March, and for the 3 years ahead, they slid to 2.5% from 2.9%. Jamie Dimon will be on Capitol Hill today. Bloomberg has learned the J.P. Morgan Chase CEO will meet privately with a group of moderate House Democrats to talk about banking and the U.S. economy. The closed-door lunch takes place as Dimon has been urged to enter the 2024 presidential race, despite his protests that he does not plan to run. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. Today, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iveson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg The Open with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
Ultimately, this is going to be about a choice. And so it's as much about Joe Biden as it is who Republicans choose and or if there's a third party candidate. So the 2024 election is going to be a big wild card for the market for the rest of this year and especially, obviously, next year.
That was Ed Mills, Raymond James, Washington policy analyst, yesterday talking about what we have ahead of us for more than a year of excitement as we gear up for the 2024 elections. The candidate pool for the Republicans has gotten pretty big. It is getting bigger. We have heard from, of course, the former vice president. We also have, of course, potentially get Chris Christie today saying that he is going to enter the race. I'm Lisa Abramowitz. I'm not here with John. I'm not here with Tom. John is off. He will be here at 9 a.m. or rather in Newport Beach. But I'm so lucky to say, even better, we have Julian Emanuel stepping in for the hour to join us. And I have to say, we got over the debt ceiling drama. How much are you really turning your focus already to the political sphere ahead of next year's election?
Well, it's certainly interesting to conjecture, but again, as even the most devoted political followers will say, it is a long time, A, till Iowa, and B, till the general. So much can happen. It's definitely a consideration, but in terms of moving the markets, very little at this point.
Well, it certainly moves the news airwaves. And I will say New Jersey Governor Chris Christie, former New Jersey governor, is likely to enter the race today. And then the wild card is whether Virginia Governor Glenn Youngkin joins the fray over the next couple of weeks, which is what PIMCO is actually looking for. And that would bring the total pool to potentially 12 by July. Joining us now, Terry Haynes, founder of Pangea Policy. Terry, do you think that it's going to come to that by July we will have 12 Republican candidates duking it out to try to get the upper hand from the former President Trump?
Oh, I think so. Why not? You know, the more the merrier. What people have reverted to in the Republican field is the idea that, you know, there's career advancement involved, that you can advance your career more quickly by joining the field than by staying out of it. And, you know, secondly, there's a why not me aspect to this where, you know, what a lot of people sense here, a lot of these candidates sense, is that they're going to be the electorate's going to be hungry for alternatives as Trump continues to be weighed down, and so there's a good opportunity for them. So in a sense, the field is kind of looser and more entrepreneurial than it has been for quite a while.
There was a New York Times article yesterday about the Trump Slayer. That was what they were calling Chris Christie, that his job was not to get elected because he had no chance to win, but that he would come out with, as we just heard from Julian, boxing gloves on, and he would have a go on stage with the same kind of tenor that the former president has had on some of these debate platforms. Do you think that that is a good approach? Do you think that's likely what we're going to see?
Well, I think we see that from a lot of people. You know, Governor Christie is an enormously capable politician and a successful one. He comes with for most of the Republican field, he comes with the detriment that he's from New Jersey, that he's from a kind of a blue East Coast state that is distrusted out there in the heartland. But the big difference between 2016 and 2024 is going to be that the vast majority of these candidates come in honed to take Trump down. So there's a possibility here that there might be kind of a pack swarm mentality that helps let the air out of the Trump balloon.
So, Terry, let's sort of just step back for a second. Obviously, you've got Trump as the very clear front runner right now, and then Governor DeSantis as the rather clear second place. Who amongst the rest of the field, it's almost like a Kentucky Derby bet where you're betting the field, who among the field is likely to emerge, call it by Labor Day, as the potential challenger to those two?
Well, I don't think it's going to emerge necessarily by Labor Day, but the two that I would suggest folks look at are former Governor Haley of South Carolina and Senator Scott of South Carolina. Haley's making a very good and interesting pitch, by the way. I think to those who want less partisanship, but people to move forward in Washington. She's offering that alternative with a good deal of specifics. It's a refreshing change of pace in just terms of how she talks about it. Senator Scott is the classic feel-good story of this field. He's very articulate. He is a worker in the Senate and very conversant with policy of all kinds. And, you know, both of those, I think, are going to distinguish themselves.
Meanwhile, we're talking about the potential field. I'm wondering about policy. In particular, Speaker Kevin McCarthy speaking on Monday about how he doesn't really see a lot more aid heading over to Ukraine at a time when it seems like there has been an escalation in the war with the accusation that Russia blew up one of their dams. How much are you focused on this? That sort of one of the talking points of the Republican side is to cut off or sort of end some of the participation or the monetary aid to Ukraine.
Well, I'm very focused on it, but I think right now what you've got is right after the debt ceiling, by the way, which I think is important. What you've got is a situation here where what Speaker McCarthy is talking about is, hey, we just negotiated spending deals. I'm not going to deal with this by just blowing up the deal in some sort of a supplemental. I'm going to wait and see what they actually need, and we're going to address this as part of our regular process in the fall and into the winter. Whereas you've got a lot of Republicans in the Senate, people like Lindsey Graham, for example, who are saying, no, they need the aid now. What's going on underneath that, by the way, is my suspicion that if the Ukrainian counteroffensive doesn't succeed completely, but it succeeds at least in part, what you're going to get coming in 2024 is a lot of Western ally pressure to settle this thing through negotiations. And you see on the other side, China already trying to make these moves by re-enlisting Macron. So this is going to be the summer that tells the tale for Ukraine. And Speaker McCarthy doesn't really have to make a decision soon, so he's trying not to.
Terry Haynes of Pangea Policy, thank you so much. Julian, I have to say, as we talk about all of these issues and the presidential candidacy and the sort of growing field, there are reports that JP Morgan CEO Jamie Dimon is heading down to Washington today to meet privately with a group of moderate House Democrats to talk about the U.S. economy, banking, etc. Is he running?
Probably not. Okay. To me, the scenario where he runs is if, let's say, President Trump clears the field and then his legal woes overtake him next year as sort of a potential substitute. But I don't think so. I think that, Jamie Dimon is among the world's foremost bankers of all time and is likely, very best positioned to continue rendering financial advice in that context.
How do you feature some of the sort of tit for tat that you don't necessarily have as market moving, but sort of the policy implications of that? How do you factor that into models that are already about as cloudy as they've ever been?
Well, look, we know that for one, the Treasury has to issue more debt. Fortunately, has to issue more debt because we fixed that, and there is a little bit of a crowding out effect. We also know that, look, as minor as it may be, we may have turned the coin on, the runaway growth in spending. We got a little bit of a concession there. And so all of those sort of factor in to this idea that there is perhaps less of an infinite boost to the government supporting the markets and the economy that there was. And frankly, in the long run, if you shift things back to the private sector, that's a good thing.
All right. So you aren't not concerned, and you're not on the concern about the T-bill issuance and all that and the sort of liquidity sucking out. You don't seem like you seem.
No.
Yeah.
No.
Exactly a big thing as you look for 44.50 potentially by July, upgraded from 41.50 previously. A shift on Sunday. Coming up, Pooja Sriram, U.S. economist at Barclays, as we wait for the CPI report on Tuesday. Does it show the rapid deceleration that Ed Hyman is looking for? Today, we are looking for a pretty quiet day, although possibly a new bull market. This is Bloomberg. Don't go.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. Welcome back. This is Bloomberg Surveillance with John Farrow, Tom Keene, and Lisa Abramowitz, except it's not with John Farrow or Tom Keene today because they are both off. Actually, John is not off. He is in Newport Beach, probably waking up at the crack of dawn or not even. And we will be getting to him later. We have Julian Emanuel with us from Evercore ISI for the full hour, which we are very excited about. Right now in markets, you are seeing a bit of a range-bound feel as we sort of tread water, trying to bump up against that 4,300 test. A lot of people, not just Julian Emanuel, but also Lori Calvasini yesterday coming out and upgrading their forecasts potentially to 44.50. That from Julian. We are seeing a bit of dollar strength versus the euro, but again, that pair has been pretty much range bound. And interesting, the Russell 2000 kind of going nowhere, but still not lagging, which is interesting. Overnight, there was actually a pretty significant move from the Reserve Bank of Australia. They were expected to hold rates firm. They did not. They raised by 25 basis points to the highest level, 4%, going back to 2012. At the same time, at the same breath that Australia sees inflation reaccelerating, you see over in Europe, the ECB coming out and saying that consumer expectations of inflation have dropped quite considerably in the month of March. What's the truth? Is inflation decelerating more quickly, or is it stickier and reaccelerating in other areas? Michael McKee will give us all the answers. Bloomberg economics and policy correspondent joining us here on set. So what is it?
I wish I knew, because then I would be able to tell Julian how to bet for the Fed meeting next week.
Which is the goal.
The problem is inflation has stalled out in the U.S., and the Fed thinks it's going to start going back down again, but that's what they thought in Australia. And then inflation came back, and they felt they were forced to raise rates, and they came out with a statement that basically reads like we're going to see from the Fed that further rate adjustments may be necessary depending on how the economy evolves. So they're leaving their options open to go the other way even further. The inflation expectations numbers don't tell you as much because it's largely based on what people are seeing with energy prices, gasoline, and that sort of thing. So those are likely to turn around as gas prices go up, with Saudi Arabia cutting production. So we could see some changes there. And obviously, the final point I'd make is that inflation numbers are backward looking, but they're all that the central banks have to make their decisions, really. And so if we get a big number next week, which we're not supposed to get, according to the Bloomberg survey, then the Fed might be forced into raising rates again.
I can feel sort of the blood moving up in Julian's arms, basically, as he thinks, no, inflation is not going to surprise to the upside. It's not reaccelerating. So how do you push back against that?
Well, so I'm just curious. You know, it seems like we're going to the next level, that Australia is perhaps a one-off. You listen to Madame Lagarde saying we have to stay tough, but that the expectations falling. Are we into the point where it's more like, jawboning rather than anything? I mean, and that in the context of we do believe that they will pause next week.
Well, it's jawboning to a certain extent, but it's can they back that up? The problem with it, the Fed is that the markets front run them, and if we do get some kind of inflation scare or something else that happens that causes the markets to move, then the Fed will be forced into the situation of either reacting to it or raising questions about why they're not, because the reaction function isn't well understood at the moment. They're hoping that they can just stop and hold, but they're going to go into this meeting with the idea that if we do not move the rates, we're going to leave people with the impression that we might in July. And certainly there's a more than 50% chance at this point that they're going to raise rates in July, according to futures trading. But an interesting question, and I asked this yesterday from people who were here, is you get the futures telling us we're going to get rate increases, and then at the end of the year we're going to get rate cuts. But then the traders, the people who are actually making these trades on everybody's desk, are saying, we believe the Fed. We think they're going to either raise rates or hold. We're not going to be cutting rates. Is the same for you?
So for us, the prospect of cuts priced in later is more of a probabilistic risk management type of situation. Our forecast is you are going to get a recession. The question is how deep, how long. If it's, sort of the down 1, down 2 quarters that Ed Hyman expects, we don't think the Fed will cut, but it's probabilistically if it's deeper or if there's, reverberation of the bank stress, that's it. But I think the expectation is there really won't be a cut in the near future.
And everyone seems to be pushing back some of the recession forecasts, including Pooja Sriram and the team at Barclays. They adjusted their outlook, writing, quote, they are pushing back their recession forecast to the fourth quarter of 2023 and penciling in 25 basis point hikes in July and September, with a meaningful chance that one is pulled forward into June. Pooja Sriram, U.S. economist at Barclays, joining us now. So is this basically not a soft landing, but a no landing for now until later, or is this simply something else where the pain is going to be greater because of the delay in the meantime?
Hey, hi, good morning, Lisa. Yeah, great question. In fact, we revised our outlook just looking at the sheer strength of the hard data on hand. At this stage, so late in the rate hiking cycle, one would have expected monetary policy to have gained more traction. But that clearly hasn't happened. So, if you look at the length and breadth of the data, whether it's consumer spending, whether it's labor markets, hints that housing demand is beginning to firm as well. It all seems to suggest that, that slowdown that, we had penciled in might take longer to materialize. And so, we think that, there is a slowdown that will happen, but it would be later in the year. And, we're also penciling in a shallower recession now. It's about 3 quarters of very modest negative growth, in fact, pushed out into Q1 of next year. So I think it's going to be a tricky situation where we think it'll take longer for the monetary policy tightening to beginning to see some effect on demand and activity.
I hear more and more people.
So they will hopefully land.
But, this is what I keep hearing from more and more people. It seems like the soft landing scenario is coming back. And nobody really wants to say it because it's almost like, this time is different. It's sort of a natural curse the second you say it. But are you getting in that camp?
Yeah, I guess it's hard to see. It's hard to see this playing out in a different way. Of course, there is the risk, as Emmanuel just pointed out, that we could get an aggravation of the bank lending crisis, and it could, possibly force us into a steeper recession. So that's definitely a tail risk that we have. But just looking at how things are playing out, this is where we stand right now.
So, Pooja, from an equity perspective, we're sort of flummoxed by this idea that particularly if you look at the financial crisis in 2008, that the equity market didn't make its final peak until about 2 months before the recession began. So I'm curious, what are the maybe 1 or 2 guideposts that you're looking at in terms of, higher frequency data that tell you that recession is closer or further away?
Yeah, I think one of the things that we have been focusing on is, of course, what's happening to the labor markets. So a lot of the resiliency that we're seeing in the U.S. economy, I think, can be tied back to labor demand, to, still very strong payroll growth. And, we will be looking for signs that perhaps, we're seeing job openings starting to come off gradually, signs that, maybe initial jobless claims begin to start ticking higher. So definitely want to see some progress in terms of labor market conditions easing. Admittedly, a lot of this data is somewhat backward looking, as in we don't get much high frequency numbers here, but really, I would look at that more closely. And then we also have some soft activity data that would, that do typically provide pretty decent signals, like the ISM surveys, for example, which, have been pointing to some moderation in activity recently. We got the ISM services print yesterday. So that seems to have settled in at a pace of, very modest growth in the services sector. We see new orders coming off, employment having come off slightly. So let's say that continues to move in the right direction. That would perhaps be a sign that at least we're entering into that phase where we should expect activity to begin to slow.
Julian, you said in the break that macro doesn't matter nearly as much as it has in the past, and it really is earnings and valuation. And this kind of piggybacks off of what Peter Scheer was saying yesterday, where good news is good news again, essentially, and bad news is bad for markets, sort of like the 90s. How much is that predicated on the idea that the Fed's pretty much done here? Maybe another 25 basis points, but otherwise, no.
Well, we've done an awful lot. There's no question about that. And obviously, from the Fed's perspective, part of the frustration is that everything they've done essentially since March of last year, you've only seen telltale signs, particularly with regard to the labor market, that it's having effect. But if you're the Fed, this whole dynamic of the incredible expansion, the stimulus, both monetary and fiscal that we got in 20 and 2021, if you look back at the charts, it tells you that actually the countervailing force of all this tightening over the last year, you're still in the point where it's got to flow through. And so for us, the net out of that is that, again, it's very difficult to predict the macro right now, but the Fed is certainly, as Mike has pointed out, if the inflation data doesn't heat up again, in a mindset where, yes, we're not going to cut, we're going to keep markets on guard, but we are waiting to see how it develops, and that basically means that earnings and valuations and sentiment matter more.
Pooja, just real quick here, are 6% Fed funds rates pretty much off the table?
Well, at this point, never say never. Yes, it's definitely not a base case. We still have two additional rate hikes that we've penciled into our baseline. So that takes us to about 5.75% by the end of this year. But, let's say inflation, remains persistent. We're not seeing much signs of labor markets slowing. And if the FOMC, it truly wants to show its resolve in that it is determined to bring prices down, then, we can't entirely rule out additional rate hikes.
Pooja Sriram of Barclays, thank you. Michael McKee, thank you so much for being with us. And Julian, that seems to be what a lot of people are saying, is that kind of the Fed is not done, but getting there. And as a result, they're not as important in some ways.
Well, at a minimum, if we have less volume of Fed speak, at least we can concentrate on fundamentals a little bit more, which is why this isn't a bad week.
Okay, honestly, though, you say fundamentals, but everyone's going to focus on the presidential race. People are going to talk about everything else. I mean, come on, you know that, right? Talk about the headset from Apple, whether they're going to buy it, whether the kids are going to want it. Dan Ives of Wedbush is going to be talking about that next.
That's the life of mixed reality, Lisa.
Of enhanced, in augmented reality, you should say. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Yes, Apple is set to extend its losses after the iPhone maker launched its much-anticipated mixed reality headset at an eye-popping price of $3,499. While analysts were optimistic about the product and technology, they acknowledged that the price point was high and that it would limit the number of shipments in the near term. Meta's industry-leading headset sells for $1,000. The suspension of the federal debt ceiling is presenting a fresh challenge for U.S. banks. Lenders are struggling to hold on to deposits as customers opt for higher-yielding alternatives. Money market and mutual fund assets have soared to an all-time high. They've been quicker than banks to pass along to customers the highest interest rates supported by the Federal Reserve's policy actions over the past year. Morgan Stanley is planning to move to a new office in Singapore as it looks to expand its presence in Asia. Bloomberg has learned the company is in advanced talks to take over 5 floors of towers currently under construction. A boom in private banking, family offices, and other financial services during the pandemic has boosted demand for swanky offices in Singapore's business district. In China, hearings begin today in a Tesla lawsuit against a protester who climbed on a car at the 2021 Shanghai Auto Show and shouted that a brake failure had almost killed her family. Now, that incident fueled online criticism of Tesla in China. Tesla denied the claim and filed a case against the protester, seeking $700,000 in damages. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup.
This is a 3 as the economic picture does.
The BOK is getting ready to make this decision.
So in the same way that Mac introduced us to personal computing and iPhone introduced us to mobile computing, Apple Vision Pro will introduce us to spatial computing. This marks the beginning of a journey that will bring a new dimension to powerful personal technology.
Apple CEO Tim Cook announcing the company's new Vision Pro headset, which retails for $3,499 and is set to launch on the next phase of products. We are here with Julian Emmanuel, Tom and John, both not in today for surveillance. We'll be seeing John at the 9 a.m. hour when he broadcasts from PIMCO's headquarters in Newport Beach. A bit of a softer tone ahead of the open, but nothing particularly remarkable. And really what has been notable, Julian, has been the run-up in tech shares, has been the run-up that we've seen more than 40% gains in Apple, getting those shares to record highs, touching a $3 trillion valuation. Does it have legs? Does it feel real to you?
Well, look, there is no question about the fact that, you go back to the end of last year when AI, generative AI basically came into the public where we could get on our phones and ask a question. It's changed the psychology. And whether it's, exactly like 1998 to 00 or it's just sort of a lesser echo, there is definitely a psychological transformation. And obviously that's helped with the market cap of a lot of these companies.
One person who's gotten it right considerably, and every single time, was Dan Ives, who is senior equity analyst over at Wedbush, who has come out with one positive prognostication after another. How much do the bears hate you?
Oh, I mean, it's kind of been a bear hate party, and and ultimately, look, I appreciate it, and obviously, like, look, some of the smartest people I know are bears. I just think it's something here where the shorts, the bears, they came out of their caves last year, and obviously feeling really good going into the year. And my view is just it was going to be a lot better than fear in terms of overall tech spending. But it was our view, and we've talked about it, that it's the most transformational trend we've seen in tech since the late 90s. And I think you just can't fight that. And that's why I think names like Microsoft, NVIDIA, Apple, and others continue to go higher.
I have to say that some of my best friends are bears was always sort of the prelude to something negative that's pretty significant. I'm curious, though, after the announcement yesterday, you're still doubling down on some of the artificial intelligence embarkments of Apple, saying that this is where they're going next. A lot of other people didn't necessarily take that away from the conference. What gives you confidence that that's kind of the next phase of their explosion in valuation and growth?
And I think that's typical, right? I mean, for Apple for many years, I mean, for the last decade, there's many people I know, they've sort of fought it because they'll go to a conference, they'll just see a leaf. They don't see the forest or the trees. And I think essentially what Cupertino and Cook are building here, it's another ecosystem within the App Store. And it all, because Lisa, right now, there's a battle, a Game of Thrones for developers between Google and Microsoft in terms of what we're seeing in terms of this $800 billion AI revolution. Apple understands that. That's why they have the gold install base and they have the developers. This is the first step on a broader strategy, really to build another moat for developers and consumers.
So, Dan, it's obviously you've the big five, big seven, however many stocks you want to target, who have really capitalized on this last number of months of AI momentum. Who among sort of the second tier of maybe those companies that haven't yet fully realized the potential do you see as being most attractive first? And then the second question is, what industries in specific do you think are likely to benefit over the next year or two?
Yeah, a great question, because I think right now, okay, the first derivative, the New York City cab driver was Microsoft, NVIDIA. But so now it's like who the second, third derivatives. I think ultimately Salesforce is going to be a big derivative that no one's talking about. I think you have names like Palantir, which is another on the AI front. And I think what you're really starting to see right now from a cybersecurity perspective, it's really, as more and more moves to the cloud, more moves to AI, you're going to have huge benefits there. Names like Palo Alto, Fortinet, and others. That's why I believe this is not just, today it's 5, 7, 10 stocks. When we look out over the next 1, 2, 3 years, I think this is really what I view as like a 1995 moment, an iPhone moment, relative to where we see it over the coming years. Obviously, macro aware in terms of what we're seeing in that, but I could tell you from talking to developers, enterprises, what we see in spending, I continue to view as a green light for overall tech stocks.
So this is a faith-based kind of bet, though. At a certain point, right, this is faith that AI is going to be a transformational moment more than, say, the adoption of $3,500, augmented reality sets that people are maybe not going to buy their children for the holidays. I'm just saying personally. But I'm just wondering, from your perspective, it's not about one product. It's about sort of engaging in a whole new way of doing business and getting out front so that different companies can use your technology, software, whatever you have, in a way that transforms the way they do business, correct?
Yeah, I think it was faith-based till the guidance heard around the world, the NVIDIA, the $4 billion raise. That's where basically all the bears went into hibernation mode for the winter. And that really is what really changed everything for tech, because that was the numbers. And now in Redmond, we're going to see it. Google, we're going to see it these next few quarters. And that's why I can tell you a lot of investors, they're not looking at the next 1 to 2 quarters. They're looking out over the next 1, 2 years. And that's why this really created the opportunity in terms of a market where I think many is still yelling fire in a crowd theater.
What do you say to the clients who are worried about valuations?
So it's the same clients I've talked to over the last 22 years where I'll sit down, they'll like on transformational tech names, on the Amazons, the Googles, the Teslas. If you look out over the next year on transformational tech companies, you'll miss every transformational tech stock the last 20 years and the next 20 years. It's no different than coming out of 2000 draft 6th round out of Michigan Brady, that first camp being like, I just don't know if it's going to work. So I think that's sort of my view in terms of how you have to look at these transformational tech names.
So from your perspective, Julian, are you sort of buying into this? Do you feel like you kind of have to be overweight tech even after the rally?
So we've taken a little bit of a different tack, right? So for us, we realize that the momentum aspect, whether it's 1995, and frankly, if you think about it, if Dan's right that this is 1995 and not 98 or 99, we have a lot further to run. Or if it's later in the cycle, we like the kinds of names that have actually shown both price momentum, earnings momentum, and for us, very importantly, in a momentum-driven market, still defensive positioning, okay? And by that, whether it's a bid to puts or high short interest, and actually you get a number of sort of the second and third tier technology names that Dan mentioned, as well as actually other industrial names that may or may not end up using AI more directly in the immediate term.
When you talk about positioning, that is what a lot of people talk about. The overweights right now for the big tech names have gotten fairly extreme. Suddenly, everyone's piling in because as much as the bears might be more vocal and the ones reaching out to you to say, no way, and with all sorts of hate mail with lots of expletives, most people are saying, all right, we buy it, we're in. How much is that going to potentially challenge the ability for these shares to really rally, even if people buy into the story?
Look, no, but I still think, institutionally speaking, many have been sitting on the sidelines with their 6 reasons to be negative, and now they're like, maybe they could focus on the weather, hurricane season as a reason to be negative. I'm just trying to think about like other reasons to be negative. But I think what's really started to happen now is you're looking at the derivatives. You look at Apple from a sum of the parts perspective. I think there's a stock that continues to go much higher. You look at now, the macro is not rosy and rainbows. We know that. But I think what's starting to happen here, when you look out the next 4 or 6 quarters, if you pick, look, there's going to be fakes. There's going to be names that basically like ultimately fake it, and then ultimately that's the froth that will come off. But if you pick the winners, you pick what I've used the fundamental names to really own in cloud, cybersecurity, and AI, I think that's how you win here.
10 seconds. When does Apple become a $4 trillion company?
Look, I believe right now you could rationalize $3.5 trillion. I think by 2025, we're looking at a $4 trillion or sooner.
Dan Ives of Wedbush, really putting the bears back into hibernation as we continue to see this rally over in the tech shares. It is interesting, though, Julian, that we're not seeing any kind of interest rate sensitivity really being talked about anymore in the tech sphere.
Again, it is one of these times where there is a perception of accelerated growth and opportunity. And frankly, when you think about it, one of the best things, and we talked about this earlier, the fact that macro matters less, is that we flatline in terms of yields. Let's leave it be calm for a little bit longer.
Let's leave it be calm in anywhere other than the big tech names, where Apple charted a new all-time high. Those shares lower by about 0.6% this morning, but just off some of those records.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
And you're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5?
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags. And I remember how it made me feel. And I think fashion is fascinating for the mood changing, the confidence boosting aspects, so the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, I mean, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I mean, I watched the offshoring, I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, you know, proximity is going to be key.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Markets, after they've run this much, they're always fragile, right? So you're looking for the next shoe to drop.
I do think the Fed is driving us towards a stall speed in this economy. And when you're at a stall speed, you become unstable.
The Fed is behind us. Maybe they hike once more, maybe they hike twice more, but that's it.
I think the Fed being on hold should not be confused with job done.
The soft landing can't be ruled out. I don't think it's ever been able to be ruled out entirely.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's a return of the soft landing. I can't believe I'm saying this. Everyone seems so constructive this morning. Good morning. Welcome back. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Jonathan Farrow, Tom Keene, and Lisa Abramowitz. But John and Tom are both off today. You are so lucky because you have me. So what more do you need? You also need, of course, Greg Peters, co-CIO of PGIM Fixed Income, who will be with us for the hour from your wine club off in London, joining us here on set. Do you buy this sort of constructive feel that everyone seems to have right now?
I kind of do. I think we're past, some important events. Obviously, the debt ceiling, which was a unforced error, so to speak. The data continues to be pretty strong. I think we're closer to the end of the hiking cycle than the beginning. That's an obvious statement, of course. So I feel like we are in a better place for a little while, but there's still a lot of uncertainty in the future. But I feel like we're in a pretty decent place over the near term.
I feel like we just spoke with two equity analysts, and the optimism was just overwhelming. It was basically just, threatening bears out there saying, look, you're getting it wrong and you're going to keep getting it wrong. Do you take issue with that? Do you think that optimism is misplaced, or do you kind of jump on the same boat?
Well, it was rather optimistic, I will say. So I'm not quite that optimistic, but I do see maybe the recession that's been talked about now for, I think, the past 18 months pushed off. And that's the curiosity in the bond market and the pricing, right? So the markets are pricing in another hike and then cuts, which implies that, the Fed is going to admit in a few months' time that they made a catastrophic error, the economy's rolled over, and they have to cut. So to me, it's not about whether you're bullish or bearish. It's about the incongruency of what the equity and risk markets are saying versus what the bond market's saying.
And that does seem to be something that we see on an ongoing basis. Today, you are seeing a return to the 60-40 type of feel where it's actually working, a little bit of an inverse relationship with stocks just slightly softer in the pre-market trading. And you are seeing bonds just getting a bit of a bid, perhaps after the ISM data that came out yesterday that was a bit softer than people had expected in the services sector. You are seeing a bit of dollar dollar strength, although I got to say this pair has been pretty stagnant at 106.97 or close around 107 to 106.5 over the past few years, a few days, I should say, days. It feels like the same pretty much. And crude a little bit lower right now after people reassess the cuts that we heard from Saudi Arabia. I do want to talk about the optimism that you're seeing from some of the stock market bulls, and then also the pessimism that you're seeing implied by some of the yields. And I want to bring in our next guest. Before we do, I just want to let you know John Farrow is in Newport Beach hosting the Open from PIMCO's headquarters. He'll be speaking with CEO Emmanuel Roman, CIO Dan Ivison, and former Fed Vice Chair Rich Clarida, among others. That will be today at 9 a.m. Eastern. Today we get annual shareholder meetings from Zillow, Urban Outfitters, Freeport McMoran, and Palantir. Palantir, interesting with the AI. And today, former New Jersey Governor Chris Christie expected to jump into the race to become Republican candidate for president. How much are you watching all that, Greg?
Oh, I'm watching it pretty closely, actually. I think
Really?
it's a curiosity, number one, and then number two, I do think it's important, right? So, I think the next presidential race, where the House and Senate continues to evolve, I think is incredibly important for markets, the economy, particularly on the global stage. So I think it's really, really important, Lisa.
Well, we'll be talking about that throughout the day. I do want to get to our guest, Anna Han, who's also sitting with us here around the table, equity strategist at Wells Fargo Securities. Anna, so good to see you in person. It seems like everyone's getting back in person, which I have to say, I absolutely love. You're not quite as bullish as some of the others. Why?
Well, we do have a price target still of 4,200. It's a little below where we are in the market now because we do expect a pullback. I think when you asked Greg before, is this optimism misplaced? I would say more it's concentrated. It's concentrated in this one part of the market, which is very tech, very AI, and very growth oriented. It's really been, maybe 5 to 10 names holding up the market, leading this rally. And if we don't see that breadth expand, that's a cause for a pullback in our book. And you mentioned as well, people are kind of maybe staving off that recession another 18 months or more. We still expect something. And with that, there still is that concern that if the consumer gets hit in the pocket with labor, that is really something that we have to consider might cool the market a little bit.
How much is this that tech names you don't see continuing to rally versus the others catching up, right? Because they are so dominant at this point. It's basically where the tech goes, so too goes your S&P forecast.
You're absolutely right, Lisa, and that's the hard part. We have a market index of S&P 500, which is driven by market cap weight. And when you have these huge names in the index, that's what makes it difficult. Is this really the indicator of the health of the U.S. equity market, or is it the health of just these select 5 top 10? So when we think about the rest of the market, it brings a little concern to us to see that there are weak parts. And in particular, you've brought a couple of them up before. You've mentioned some of the risks, and these are things we have to keep in mind. So we're not quite ready to move our price target. We're holding pretty firm 4,200, and we do think it's still going to be a little bit of up and down ride for the rest of this year.
And then how sensitive do you think the equity market is to rising rates? So last year, the market was all about rates. Stocks had duration to it. Now no one cares. What is the importance of rates into your forecast?
I mean, absolutely crucial, Greg. There's this beta to the equity markets when we think about how much do yields impact. And you saw, like you said last year, yields up, growth markets down, so equity's down because growth is such a big part of the equity market. What's been kind of confusing has been now you've seen yields go back up, the 10-year trickle back up 20, I shouldn't say trickle, I should say really trend back up 20, 30 basis points just as markets start pushing out the possibility of cuts. And yet at the same time, you have growth leading the market. It's this thirst for AI, this exposure that people are so trying to get and reaching for, that's been these two clashing forces. So the question is, when do those fundamentals kick back in?
Here, the problem that I keep struggling with is I've been looking at credit markets which supposedly lead, right? They're supposedly the ones that tell you when everything is going to fall apart. And what they're signaling is, it's okay. I mean, some of the names are going to struggle. You're going to see CCC not do so well, but you're going to see some other names do pretty well. People are looking at some resilience, some even potential growth, especially given that revenues are going up with inflation. Greg, it seems like it's not that negative, like things can kind of keep chugging along, even with 5%, 5.5% Fed funds rates.
The resiliency is just amazing across all markets. The credit market, though, is notable because the construct has changed, right? So if you think about where the risk has moved in credit, it's out of the high-yield bond market into the levered loan market, and into the private market. So the risks are actually more opaque and therefore kind of less leading as they have been in the past. So I think the signal that credit has provided in the past will not be the signal in the future, just given the move towards kind of opacity, whether it's levered loans or private credit.
That's fascinating. And Anna, does that mean that some of the models that have traditionally been used to sort of forecast weakness don't really have the same clarity now, just simply because some of the readings are going to be muddied by trends like that?
I would agree with that. I think the traditional indicators we look at, the traditional parts of the market we look to guide us, be that canary in the coal mine, might not be as sensitive anymore. And you bring up a great point. It's like, have we forgotten that there still could be a lot of unrealized losses in the regional bank space, but yet credit markets are reflecting pretty healthy spreads. We saw IG spreads last month kind of do a round trip of 10, 15 basis points, but we're right back where we are. So these are the kind of things that maybe has equity volatility contained for now, but something that we want to remain cautious of and remain vigilant to stay on top of and in front of.
What would you have to see to become more bullish?
More bullish, I think we'd have to see really a Goldilocks scenario, that either we can keep unemployment very low, at the same time inflation can come down without the Fed having to do too much heavy lifting. But that's a patience game, and I don't know how patient the equity market or the consumer can be. So far we're trying to keep steady here and keep that patience. But if that can't occur, I still think you're going to see more volatility, and a VIX at a 14-15 handle is pretty hard to sustain.
Anna Han, thank you so much for being with us of Wells Fargo. Always wonderful to get your thoughts. And Greg, I do have to wonder about how much more constructive you've become over the past couple of months. Is there a fear, and this is something that a number of terminal users have really raised, is there a fear that people are kind of being brought in just before the kill?
That's classic, right? So I do worry about that myself. I would say I'm marginally more constructive.
Okay.
But I do think the cross currents and the uncertainty, remain. But as a bond fixed income person, higher yields help out a lot, and so that is, I think the important aspect of my call.
But there's an equity perspective to it as well in terms of the credit side. Are you seeing perhaps less willingness to kind of go into the riskier areas, or are you kind of getting more constructive there too, just because of that incredible resilience that you're seeing in the economy?
Yeah, so I do see a bifurcation around risk. So I do see the more risky parts of the market, whether it's leverage or highly cyclical, definitely underperforming here. I think that makes sense to me. So if you actually look under the covers and delve in, you're seeing a pretty healthy rationality in market action. So it's not like everybody in the pool. Maybe tech and AI is a different kind of story altogether. But I would say broadly, there seems to be pretty decent differentiation, which I think is a healthy sign, not a poor one.
Do you feel like people who are in the market today are not used to this? They're just used to sort of waiting for the Fed to tell them what to do and trading on big macro themes and not exactly on specific names?
Yes, and I think that is where things can unwind quickly. I still believe investors are using an old playbook. If you look at what's being priced in the market in terms of rate cuts, to me that's overly heroic. The Fed and global central banks are fighting inflation. They just can't turn on a dime when inflation is above the mandate. So I think the markets are putting too low of a bar around rate cuts, actually. I think it's a big mistake.
That people are basically thinking that rate cuts are going to happen well before they actually do. Still seeing some rate cuts priced into the market by the first month of next year, even as people say, job not done. Greg Peters is going to be sticking with us of PGIM Fixed Income. Coming up in the next hour, Neil Dutta of Renaissance Macro joining us for the 8 a.m. period. And we're going to be taking a look at what is to come, including CPI on Tuesday ahead of that Fed rate decision. The skip, the pause, words matter. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine says Russian forces have blown up a giant dam in the country's south. That blast has unleashed a deluge of water, putting 10 villages and parts of Kherson at risk of flooding. Residents are being told to prepare to evacuate. President Volodymyr Zelensky summoned an urgent meeting of Ukraine's National Security and Defense Council to discuss that attack. In France, unions are holding a fresh day of strikes against Emmanuel Macron's pension reform. Now, it's the first nationwide protest in more than a month, and it will test whether the president has succeeded in getting much of the country to move on from the politically damaging fight. Macron has faced down months of protests and strikes. He angered many when he enacted the legislation without a full vote in Parliament. Deutsche Bank's asset manager DWS Group is expanding its efforts to offer work flexibility. That began during the pandemic. The company says it will let employees work outside Germany for almost 4 weeks a year. The move sets DWS apart from many other financial services firms, which are stepping up efforts to get people back to the office. BlackRock recently told employees to be on site for at least 4 days a week. And Eaton Vance is joining the ranks of major funds looking to the frontier of the investment universe to help boost its emerging market returns. Nations like Uzbekistan and the Dominican Republic are reforming their economies and institutions. Now, the firm says that's making their assets attractive to portfolio managers. Eaton Vance has moved to reduce its exposure to China. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Today, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iveson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg, The Open, with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
You can advance your career more quickly by joining the field than by staying out of it. And, secondly, there's a why not me aspect to this where, what a lot of people sense here, a lot of these candidates sense, is that they're going to be, the electorate's going to be hungry for alternatives as Trump continues to be weighed down. And so there's a good opportunity for them.
That was Terry Haynes, founder of Pangea Policy, earlier this morning as we talked about the growing field of Republican candidates for president. And we're talking about Chris Christie potentially coming into the field today. And then a question around Glenn Youngkin of Virginia, the governor there, about whether he will also get in. Right now in markets, we are seeing a bit of a softer tone, but not exactly anything dramatic. No drama. We are seeing yields a little bit lower Crude, interestingly, and I want to give a second to this, crude down about 2.2%, even after what we saw yesterday with Saudi Arabia coming out and unilaterally cutting production by 1 million barrels per day. John and Tom, both off today. We are here with Greg Peters of PGIM Fixed Income. Is that interesting to you, this idea that we have seen the softness in oil and even OPEC Plus's recent announcement hasn't really staved this off?
Yeah, I think it's a warning sign. And, we talked about being more positive on the margin. This is something that really makes you revisit that, right? So there's something in the market price action here. I think it has a lot to do with China, of course, but it is a global growth slowdown story as well. So I think it's hard to ignore the fact that the markets have moved right past the OPEC plus cuts and continue to move lower, I think is really a worrying sign.
We're going to be continuing to parse that as time goes on. A lot of people thinking maybe this isn't exactly a permanent cut. It's just sort of a one-off, and that's part of the reason why.
It's a cheating anyway, and so it's not really a cut, and so you're seeing oil flow out of Russia and Iran, and so it's really not a true cut.
Or a lollipop or whatever people want to call it, all of the names. Talking of China, we have been hearing a lot in the tit for tat between the U.S. and China. And before we get into the rat race or the horse race, whatever you want to call it, in the political sphere coming into 2024, there is this easing of tensions between the U.S. and Chinese, and what you're seeing is some potential talk of meetings in Beijing to come to some more kind of communication, at least, to set the stage for a softening. Anne-Marie Hardern down in Washington, D.C. of Bloomberg is joining us. Now, I want to start there. We are going to get to the election later on, but how significant is it that there have been these talks by senior officials in both China and the U.S. happening in Beijing?
Well, I think one of the most significant is the fact that we have the highest ranking U.S. official to date since the spy balloon incident happened. This is an individual at the State Department who's in charge of Asia, meeting the vice foreign minister in Beijing. So they, according to the readouts, these are very frank and candid conversations, and it does seem that potentially, as you see the administration wanting to meet with their counterparts, this could be the laying of that groundwork. It also comes on the heels, of course, of other meetings between high-level U.S. officials and their counterparts. We had Gina Raimondo meeting her counterpart. National Security Advisor Jake Sullivan spent a lot of time with Wang Yi in Europe recently. And then, of course, there was this secret trip from the CIA director, Bill Burns, to China. So it does look like there is a growing of that outreach. But at the same time, Lisa, the rhetoric is very heightened right now. And we saw that over the weekend at the Shangri-La Dialogue in Singapore. Yes, there was a cordial handshake, but there was no sit-down meeting between the two defense chiefs of Washington and Beijing. And I think that's a question for the broader national security apparatus as well as business community. What does this mean for them if you cannot even have your two top-level military chiefs, which really ground zero and where a lot of the tension stems is in the Taiwan Strait. And we saw that as well this weekend with a Chinese vessel coming very close to U.S. warship.
As we gear up for the political circus that is the election, how do some of these issues play in? Basically, this China-U.S. relationship, when it comes to both Republicans and Democrats, how much splintering has there been? We have heard there's splintering over Ukraine aid. Do we get a sense of where the positions are coming out?
When it comes to China, you would be hard-pressed to find anyone in Washington or anyone on a campaign trail not wanting to take a tough stance on China. I think at this moment, it could then be very difficult for the Biden administration as they try for this rapprochement with China. Remember, we're still waiting for an announcement of whether or not Secretary Blinken is going to go. His trip got derailed because the spy balloon. Treasury Secretary Janet Yellen told me she still plans on going to Beijing. How does all of that look? While at the same time, you are going to have questions to all of these Republican nominations, and that field is widening, and it's going to be widening today when the former governor of New Jersey enters the race, Chris Christie. They are going to take a very tough stance on China, and they're going to want to do anything they do to say that the Biden administration is being soft on China. But of course, what we've seen over the past 2 years, the Biden administration has not lifted, say, the Trump-era tariffs. They've also went after China in terms of export controls and chips that could potentially use to their military. But it's going to be a place where China is going to be the foreign policy target for all of these candidates.
And then Emery, how do you see the risks receding then, right? It seems like each candidate wants to be more hawkish than the next. And so how do we kind of get out of this vicious circle if everyone is talking tough on China?
It's a great question, and I think that's what the business community is grappling with at the moment. Dan Tannenbaum, speaking to Bloomberg, talked about this, saying, you know, a lot of this is optics. When you look at what happened with the comments from Lloyd Austin and Li Shangfu in Singapore, a lot of it is optics and this rhetoric. When you actually look at the hard data, you do see record trade between the United States and China last year. I would note, though, for businesses, it's going to get a little bit more complicated as they try to navigate this. They are still waiting on what's happening with the outbound investment restrictions from the United States and potentially other G7 countries. They've talked about this at the G7, not decoupling, but de-risking. But the news this morning is that Sequoia Capital is siphoning off its China business because they find the regulatory environment just too difficult. Are we going to see more businesses do just that?
Anne-Marie Herdern, thank you so much. As always, wonderful reporting from Washington, D.C. Greg, I do wonder about that, how much you can factor this type of tension into an investment thesis if it's sort of, you know, kind of bipolar in terms of whether there are restrictions or not put on.
Yeah, and I think on top of that, you're entering this phase where China is no longer going to be the same kind of dominant global growth story that we've witnessed over the past 20 years or so. So on top of it all, you have a naturally maturing economic cycle in China that is going to have a different dynamic on the global stage. So will they fight against that or will they kind of allow it to happen?
How much has that sort of influenced whether you're interested in global bonds, whether you're interested in Chinese securities at a time when they're potentially easing policy on the margins?
Yeah, I mean, that's important, but the bigger picture story is the growth that we've seen coming out of China is not going to be the growth in the future. And what does that mean for not only global growth, of course, but global inflation, labor markets, and alike? So, you know, where to invest is kind of a smaller story. The bigger story is the influence that China has had will be very different going forward than what we've been investing around the past 20 years.
How do you hedge against geopolitical risk?
Well, it's very difficult, right? So the lesson learned last year was you have to pay attention to it, right? So in the past, you were rewarded as an investor to ignore it. But I think what happened with the Russia invasion is that you have to pay attention, and geopolitics is taking more and more importance into the thought process here. So it doesn't go away, and that's geopolitical and actually local as well. So just politics within the country like we've seen around the debt ceiling.
Well, how much are you overweighting the U.S. and saying, you know, this is home bias, especially when the risks externally are so significant?
Yeah, so I'm pretty bullish on the U.S. I think the U.S. wins and will continue to win. We like the dollar, we like the U.S., and we don't believe the story that the U.S. dominance is fading.
Right now, we are seeing the dollar marginally higher versus the euro. We'll be talking more coming up next about the fixed income space with Colin Martin of Charles Schwab and just how much people are shifting back to the U.S. after going overseas for a lot of the earlier part of this year. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Tom Keene is on vacation. John Farrow is not on vacation. He is in California, and he'll be broadcasting from there at 9 a.m. Right now in markets, a bit of a softer tone as we sit and look at a quiet period for the Federal Reserve, but not anything but when it comes to some of the geopolitical action. We are seeing a bit of dollar strength. We are seeing a bit of resilience in the Russell 2000. What you're seeing in bonds is yields marginally lower after softer ISM data that came out yesterday, perhaps giving people a sense that there isn't this sort of runaway growth being fueled by the services sector. 10-year yields 3.67%. The 2-year space is just basically stagnant at 4.5%, a little bit below that. And what you're seeing is a bit of euro weakness versus the dollar, but really sticky in terms of a level. This has been really notably sticky over the past couple of days, 106.91, as people try to understand whether the ECB is going to stop cutting rates later this year after they see inflation coming off just a little bit. And taking a look at some of the names that are moving this morning, it basically is a retracement of Apple and a retracement of NVIDIA, just marginally with both those names down, less than 0.5%. But I'm really watching Exxon in particular. Those shares lower by more than 1%, following on from already a pretty underperforming kind of level this year, even after the cuts that we saw from Saudi Arabia. I'm so glad to say that today we are joined by Greg Peters for the 7 a.m. hour of PGIM Fixed Income. I mean, honestly, I keep looking at this market and I just think it's going to melt up because that's basically what's been happening every single day.
Well, lack of data should help that along, and the summer quiet period might help that along. But we still have the Fed, we still have inflation, and the data is very, very mixed. So it might not be as planned, Lisa.
Our next guest is also in studio, and before we get to him, I am curious: is everyone going back to the office? Is this basically a massive push that you're seeing kind of accelerate recently?
Well, I think there's that move. I think from an investment trading perspective, being on a trading floor, being together matters and matters a lot, right? You have the kind of the natural conversation, free flow exchange of ideas, and I think we're kind of reverting back to normal.
Well, let's have a free flow exchange of ideas with Colin Martin, fixed income strategist at Charles Schwab, joining us here on set. Have you noticed that as well, that people kind of are all coming back and it's kind of accelerated over the past few months?
I have noticed that just on my commute in. We used to see Mondays and Fridays were pretty quiet, but I came in yesterday and the commute was pretty busy. So we are starting to see more activity.
Are people revolting against that? I mean, I will get to bond markets, but there was a story that really struck me today in the Wall Street Journal about Farmers Group in California and how there was a CEO who said, you guys can all work from home. And then K-Bed said, just kidding, a new CEO saying, actually, you're not going to be remote after all, and people revolted. We're seeing the same in Amazon. Are you hearing about that, or are people excited to go back?
I've seen the headlines. I've heard it, but I think it is mixed. In that instance, I'd be a little surprised if that was my plan to work remotely. But I think people are okay going back in. I think the camaraderie, meeting people, exchanging ideas, I think that's really important, and I know that we're seeing that on our end.
so your boss can just know that he checked off all of those boxes. I'm kidding. I think a lot of people do agree, and it's just so wonderful to have you in the studio. Colin, I do want to start with this general sense of optimism and frankly, this idea that we're getting a soft landing or something that looks much better than it did 2 months ago. Are you kind of buying into that belief?
Well, somewhat. We're still cautious, but every month and every week that passes, we're getting more data that comes in that kind of pushes back that arrival of the recession. Now, we have seen a lot of mixed data here and there. What we're seeing is a lot of the surveys are pointing to slower growth, whether it's all the regional Fed indices, whether it's the ISM manufacturing or services yesterday. But then when we look at the actual hard data, the labor market still appears tight, although albeit with some cracks. Inflation's still high, and spending is hanging in there. It's not going gangbusters right now, but it hasn't declined the way we would have expected. We do think we'll continue to see growth slow. If we look at GDP on a year-over-year basis of close to 1.5%, that will likely continue as the lagged effect and impact of all the Fed tightening works its way through the economy. But things are okay, and they haven't slowed down the way a lot of people really expected.
Colin, what do you think about inflation? So you're talking a lot about growth, but inflation is still hanging around. How is that driving your forecast on the rate side?
Well, it's still sticky. So if we relate the inflation outlook to what might happen to the Fed, it's really difficult to see how they cut anytime soon. That's a big discussion lately. The Fed funds futures market is still pricing in a cut, but with inflation, it's still 4 or 5%. That's still too high. We look at average hourly earnings, and it's moving in the right direction. But if you look at those monthly numbers of 0.3%, 0.4%, that's just too high. So if we look at that and add that all in with a strong non-farm payrolls number, things are still okay. We do think inflation will decline over time, but it's proving to be a little stickier than a lot of us thought.
Well, but I would ask both of you this, because I know both of you think that rate cuts are pretty much off the table for the rest of this year. I'm looking right now at Fed funds futures, and it actually shows an implied rate of about 5% at the end of this year. We've priced out a lot of the cuts that were priced in earlier, and markets haven't really gotten shaken. Has that surprised you, Greg?
It has. What's even more interesting is it's pricing in another hike and then a cut. Slightly, but not as extreme as it was a few weeks ago. Yeah, but I'm really taken back by this narrative that the Fed will cut and therefore risk assets will do better, right? It misses a central point as to why they would cut in the first place, and it goes back to the hurdle has to be extremely high for the Fed to cut. And they're just not going to cut because they feel like it, and that goes back to the inflation question that I asked.
Yeah, that's our exact view. The Fed's only going to cut if they need to. If inflation's still high, if they have to, they don't want to cut. We've heard that from Fed officials. They don't want to cut. I mean, that's stimulus, right? So if we look at what might happen if they cut, if that's good for risk assets, we're in the same camp as you. That's not a good thing because they're cutting because they need to stimulate the economy. That's not a good outcome.
But the fact that we have seen such resilience in credit markets suggests that this is an economy that can withstand rates that are higher for much longer than anybody previously expected. So at what point do you say, okay, let's say they keep rates where they are for a foreseeable future. Why can't you collect the coupons on riskier debt and just be happy with that, Colin?
I think the outlook is negative because of the point you made, higher for longer. Over the past 15 years or so, we haven't had this period of high rates. Anytime we've seen rates rise, they've come down, and it's allowed companies to kind of take advantage of that lower entry point. If you go back to 14, 15, with the oil price-induced spread rise, that came back down, and companies didn't need to lock in those high yields. We're at this point right now where high yields are 8%, 9%, 10%. They're probably going to stay there for a while. So it's not like they're going to have this exit point where they can go back in and refinance or even come to market with new debt. And then if we look at the leveraged loan market, those companies are getting hit right now. I mean, they're hit very hard by that rise in interest expense. They're seeing their annual interest expense double or even triple. That's going to hit their bottom line in a period when revenues are already in trouble.
I still think there's a chance, a really good chance, that rates will be higher for longer, and surprisingly so, right? If you script out this soft landing narrative, the Fed doesn't cut, the front end stays where it is, and then there's a normalization of the curve. And I think that's a real possibility, and in fact, that's what we're playing for. As far as pricing is concerned, as a fixed income investor, you're actually paid to be short the front end because you roll up. Right, so it's extremely advantageous to be short versus long. And I think that's telling you something, and it matters. So I think the bias is for higher rates, not lower rates. It's predicated on the Fed not moving or normalization.
So are you saying that basically the whole curve could be at 4.5%, 5%?
Well, in a normal world, it should be, right? So, I mean, should we be persistently inverted, right? The inverted curve is telling you one or two things, or both, is that the Fed is cutting rates or we're entering a recession. So if we don't enter a recession and the Fed doesn't cut rates, then something has to normalize, and that normalization means higher rates, not lower rates.
Colin?
I think that's a good point. Now, I think we could see a normalization, but probably at a lower level. To get all yields up to that 5% area, it's not just a soft landing, it's everything's fine. The economy can really withstand the amount of rate cuts and such a high level of yields. But if we do get this soft landing that everyone's hoping for and wishing for, then maybe we see intermediate and long-term yields rise a little bit, and then over time the Fed cuts rates, but at a higher level than what the markets are projecting right now. So maybe not 3%, maybe 4%, something like that.
How much, and this is a viewer writes in, and I think it's a good point, how much is it that higher rates is actually stimulatory? That people are actually getting income and suddenly they can reinvest it in real things instead of having sort of the disinflationary and sort of, in some ways, outright deflationary idea of negative rates or zero rates?
Yeah. Well, I think we're seeing that right now. It is a good thing. I mean, when we talk to investors and the rates they're earning, these are the highest yields they've seen in a while. And I think one way to look at it is leverage in the system. And at least on the household level, it is lower than what we've seen in previous periods of excesses. And especially when we look at the mortgage market with people locking in such a low rate, maybe the rise in yields isn't impacting people as much as the Fed would have expected.
History is going to shine a very unfavorable light on zero and negative interest rate policy. Right, it's had the opposite effect, as you alluded to. So I think higher rates is great for savers. It is stimulative. And like I said, the history books are going to look back and say, wow, that was not a great idea.
On Greg's point, I agree with that. And I think the whole idea of zero interest rates has kind of distorted what we've seen in the markets, where prior to 07, 08, 09, that zero wasn't a thing. And if the Fed does cut and only down to 2.5, 3, 3.5, maybe intermediate and long-term yields won't necessarily fall as much as the markets are expecting.
We're running out of time, but all of this sounds very constructive and normalization after 2 decades of a pretty extraordinary policy. And yet, I have to wonder, all of those excesses, we're not going to see any overhang from them. We're going to just chug along and everything's going to be fine. I mean, at what point do you start to say, actually, there will be some distress, whether it's commercial real estate or private credit?
Yeah, no, we are concerned. I don't want our outlook to come out too positive right now. We've been cautious on credit. Our focus has been on higher quality. And with yields where they are, this is our main thing that we're talking about with clients right now. If you can get 3.5%, 4%, 5% or more in high quality investments, why take that risk elsewhere in junk, bank loans, things like that? We think there'll be better opportunities down the road because we do see risks. When the Fed hikes to whatever the peak ends up being and holds for a while, key point being a while, we see negative impact there, and we do expect growth and inflation to slow.
Yeah, and the Darwinian process has just started, right? I mean, how many business models have been predicated off of zero interest rates, right? So you're seeing it in CRE, you'll see it in the corporate community, you'll see it on the consumer side. It just is taking more time than I think initially forecasted, but I do think it is occurring.
As Jim Reed over at Deutsche Bank said this morning, we're playing the waiting game, and that seems to be where we're at. Colin Martin of Charles Schwab, thank you. Greg Peters, unfortunately for you, but wonderful for us, you're sticking with us. Coming up, we've got Stephen Shork of the Shork Group on oil, which we were talking about earlier as a potential indicator of global growth. What does it mean that oil prices are still going lower even after the output cuts from Saudi Arabia? This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Jamie Dimon will be on Capitol Hill today. Bloomberg has learned the J.P. Morgan Chase CEO will meet privately with a group of moderate House Democrats to talk about banking in the U.S. economy. The closed-door lunch takes place as Dimon has been urged to enter the 2024 presidential race, despite his protests that he does not plan to run. Apple is set to extend its losses after the iPhone maker launched its much-anticipated mixed reality headset at an eye-popping price of $3,499. Now, while analysts were optimistic about the product and technology, they acknowledged that the price point was high and that it would limit the number of shipments in the near term. Meta's industry-leading headset sells for $1,000. The roaring rally in tech stocks still has further to go. That's according to Citigroup quantitative strategists who say the buzz around artificial intelligence and hopes for a pause in the Federal Reserve's rate hikes gives them an edge. They say they are positive on growth for June and see more tailwinds than headwinds. Consumer expectations for Eurozone inflation eased significantly in April, giving the European Central Bank more reason to end its run of interest rate hikes this summer. According to the monthly survey, expectations for the next 12 months fell to 4.1% from 5% in March, and for the 3 years ahead, they slid to 2.5% from 2.9%. Gun demand in the U.S. reaches the lowest level in 7 months. Unadjusted criminal background checks, they fell 11% in May compared to a 9% increase a year earlier. That's according to the FBI's National Instant Criminal Background Check System, which is a proxy for sales by the firearms industry. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I think Saudi Arabia sees itself now as a central bank of oil, and that it's, as the oil minister said, the petroleum minister, they would do anything to stabilize the market. The demand has not been what people thought. There's been disappointment over China, glumness about Europe, and uncertainty about the United States. And so they don't want to get in a situation where the price slides further and you have a tougher time climbing out of it.
That was Daniel Yergin, S&P Global Vice Chair, speaking with David Weston yesterday. Today, we are seeing oil prices lower yet again, even after the output cuts promised by Saudi Arabia, 1 million barrels per day. This, to me, is one of the more interesting aspects of today's markets. Otherwise, you're seeing basically a flat S&P. Actually, the NASDAQ has turned upward just a touch in pre-market trading. You can't keep a good tech down. You are seeing a bit of softness in the euro versus the dollar, 106.87. Yields a touch lower, basically range-bound 3.67, and that crude level 2.5%. Kind of fascinating given what we heard yesterday out of Vienna. I am here, I'm so happy to say, with Greg Peters. John and Tom both are playing hooky, and we are so blessed to have you with us. I am curious, you were talking earlier about how this is really important to watch as a key indicator going forward.
Yeah, well, it's a great read into global economic growth, right? And so I think a big part of the reason why oil has softened is because the belief is that growth is coming off the boil, right? And so the demand is lower, and that's driving energy prices, and the cuts, maybe we're still out of balance with the cuts. And so I think it's a global growth insight story.
Well, especially given the fact that China seems to be concerned enough about growth that they're actually working on trying to stimulate and perhaps peripheral measures, whether it's encouraging state-owned banks to possibly drop some of the deposit rates, not mandating it yet. But right now, I am curious to hear some of the dynamics and what's sort of reflective of what's going on in China with Stephen Schork, principal at the Schork Group. I want to just start there. How much is lower oil prices really just simply a reflection, a readout on the Chinese economy?
Yeah, absolutely. To Greg's point, oil, as with natural gas, as with all energy, is your greatest leading economic indicator. So there's always this belief in the market when we see low oil prices or low commodity prices, somehow this is good for the consumer. No, you get low commodity prices because you have flagging economic demand. And this is the scenario we're at right now. Natural gas prices are depressed, well below $20 barrel oil equivalent, and oil now is failing to hold support around that $70 level. So clearly this is a sign, and we knew this going into the OPEC meeting. When we look at the market's term structure, whether in the domestic markets, the European markets, the Middle East, North African markets, we've seen a collapse in demand in the spot market. And we've seen this inversion in the term structure and this pricing. That is your clearest telltale that there is an imbalance between supply and demand. Now, OPEC took a really odd step. They really made a mistake here, and that is Saudi Oil Minister Abdulaziz bin Salman. He's been very vocal over the past month, warning speculators, bearish speculators, that they're going to ouch. Now, this is a very uncharacteristic move made by the very staid Saudis, and I think it really tipped their hand. In one of his statements, Salman said he's not a poker player. Well, that is clear because he really tipped his hand at this point, almost asking Wall Street to stop selling this market. So now it is a put up or shut up time for OPEC. They've been talking the talk, they've got to walk the walk, but the bigger concern now is what we're seeing in the spread markets is that economic demand led by China is a major concern, and we're seeing that reflected in price.
Stephen, I'm curious, how out of balance do you think the market currently is? So what do we need to see in your mind in terms of cuts in order to bring supply-demand back into balance?
Yeah, absolutely. Well, Greg, we're starting to see it here in North America. We're starting to see the rig counts, both in Canada and in the United States, take serious declines, really abnormal outside declines that we've seen over the past month. So this is our first telltale. But it's more important about OPEC. And there's always that push and pull between the International Energy Agency based in Paris and OPEC. IEA is always saying, OPEC, you're not putting enough barrels on the market. OPEC is saying, wait a minute, demand's not nearly as strong. I trust OPEC at this point. They're telling us 2 million barrel cut in April, this ongoing cut, discussions over the weekend. Clearly, we're probably out of balance, upwards of 2 million barrels, that chasm between supply and demand globally going forward into the summer season.
But Stephen, how much is this a short-term kind of confluence of events where you're going to see short-term weakness that only leads to higher prices later on because of a lack of investment by some of these oil majors?
Yeah, absolutely. The short-term weakness we're now seeing, Lisa. Now, what was interesting is the Saudi was saying, hey, Wall Street, stop selling. But going into that weekend, proprietary trading desks, traders that trade on their own firm's behalf, those bullish desks increased to the highest level since April 2020, and they took a bullish position that we haven't seen in the past 58 weeks. So they're getting stopped out right now, and that's a very short-term effect. But to your point, with the lack of investment going into hydrocarbons, the game we were playing on Wall Street, where it's a zero-sum game, I cannot put any dollars into a hydrocarbon because they all have to go into renewables. Okay, if that's the way you want to move, that's the way you want to invest, you have to be willing to pay the piper. And when we're not putting those dollars into advancing hydrocarbon, in addition to, we're of course going to lead to the greatest axiom in economics, that capital goes where it's welcome, stays where it is well treated, not being well treated, not welcomed in hydrocarbons, and therefore that could only lead to greater volatility, higher prices when we don't have sufficient supply infrastructure to get that oil from where it's being produced to where it's being consumed.
That said, Stephen, I do wonder how much this is starting to reverse in a pretty meaningful way. We already saw pushback from certain shareholders of big oil companies saying, okay, stop it with all the renewables, just invest in your core business. It seems like, despite some of the signs that global warming is continuing and that the climate is continuing to be an issue, people are sort of, okay, we've maybe overstated that. Is that what you felt as well?
Well, the climate, Lisa, has been changing for the last 5 billion years. So the question is, who is responsible? I'm going to say nature is responsible. Now, what we're seeing in the global economy is, hey, Germany, Europe's largest economy, is in recession. Why are they in recession? Because they went all in on renewables. They deemed natural gas to be on the wrong side, and they drove natural gas prices to the equivalent of $600 oil last year. Hence, they're in recession today. The United States is going that way with regard to its move to get away completely from hydrocarbons. So I think the writing's on the wall. Let's learn something from Germany. There's a balance here. We have to invest in renewables, but that cannot come. This cannot be a binary investment. You have to also indulge hydrocarbons. And I think slowly that pendulum is beginning to turn.
Stephen Schork of the Schork Group, thank you so much. You're nodding, Greg. Is this something that you keep hearing as well?
Yeah, no, I think the answer is both, right? And Europe is a great example. So Europe has to spend for near-term energy security and for renewables and green initiatives, right? So what you'll see and what you're seeing in Europe is they have to spend in ways that they didn't envision in the past.
How much are you willing to fund that as a debt investor?
Well, I think if you look back in kind of Europe fiscal history, there was too much austerity. So I think a little more, but it's a delicate balance. But I feel better about spending and trying to grow than continuing to retrench.
Well, going forward, I'm wondering, though, just in general, how much you are focused on the U.S. You were just talking briefly about that earlier, that you do see some upside to the dollar. How much? Is this really going to be sort of a driver of the remaining part of 2023?
No, I don't think it's a massive move higher. I just think it's a steady kind of strength. And then we will have this sequencing shift, right? As let's say the U.S. rate market starts to stabilize, Europe continuing to raise rates, I think you'll see a switch, but I think it's too soon for that.
This has been really fun.
Thank you
for
Thanks
being
for
here.
having me.
Do you want to become a TV host? You can join. You know, there's a couple empty seats.
I want to take Tom's job.
Well, I think, no one's here. No one's watching. So, Greg Peters of PGIM, thank you so much for being with us. It was truly fabulous having you right now in markets. Again, you just see that melt up, that desire to go upward with the NASDAQ in particular, just crossing into green briefly. The S&P still a touch lower, but basically just still treading water near that 4,300 benchmark, 106.81 for the euro dollar. And you are seeing yields just a bit softer on the 10-year after we are in this quiet period ahead of next week's Fed meeting. Crude prices, we were just talking about that, lower by 2.2% despite the recent OPEC cuts. This is Bloomberg.
Welcome back to another special Roland Garros update for Bloomberg TV and radio from Tennis Channel. I'm Erin Coscarelli. Last year's finalist Coco Gauff reached her third career quarterfinal at the Slams after she got past Anna Karolina Schmiedlova in straight sets. After edging the opener 7-5, the 19-year-old took control in the second, taking the last 5 games of the match before closing it out 6-2 after just over an hour and a half on court.
So I notice in a couple of drugstores, even in my area, which is not the poorest area in Washington, D.C., it's a nice upscale sort of area. When I want to get razor blades, you have to go to the front of the place and ask somebody to unlock it. Why are you locking up razor blades and other things that I might want to buy?
Yes. So, this is a national problem. And, this isn't, random theft. This is organized crime. And, state legislation has put guidelines on, how much the theft that you can steal before you're convicted. So it's a $1,000 limit. But we have been partnering with other retailers and sharing our camera feed. I know some of our partners here from Walmart are here, but we're all part of an organization that's coming together that says if we can put our camera feed together and tell that person has been in our store and their store and the numbers are higher than 1,000. So we've been able to impact these theft rings most recently.
What are the things that are unlocking key the most? What are people trying to steal the most, other than razor blades, I guess?
You know, I will tell you, it started at razor blades because that's such a high ticket item, but you know, it's a lot of cosmetics, but really what happens is that they take advantage of what I would call the elbow move, and they just come in and swipe a counter. And so it's just a matter of categories now.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
If you really still believe in the 2024 recovery thesis, it's probably going to end up being a good buying opportunity.
I'm expecting the U.S. economy to, in the second half of the year, roll over into a recession.
You're seeing, I think, right now a real groundswell of hope that there's going to be a soft landing.
We're in a stage where good news is going to be good news for markets, and bad news, if we get it, will be bad news.
I think good news is back to being bad news.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good news will be good news, at least for this hour. Good morning. Welcome back from New York. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. I'm Lisa Abramowitz. John Farrow and Tom Keene both ditched me, but no, one person who did not is Neil Dutta of Renaissance Macro, who is joining us here for the entire hour. So pleased to have you. Thank you for being here.
That was great.
But you were laughing. Why were you laughing?
Well, it's just a reminder that when you put two economists or strategists in a room, you're lucky if you get 6 opinions. So.
Well, that seems to be where we're at. So what do you make of that? I mean, it seems like that's even more the case now. And it's not just near term, it's even long-term parameters for how to look at the world.
I just think it demonstrates that there's a lot of confusion in the market. And I think that's primarily a function of the data as it's coming in, right?
Yes.
So it's been a very mixed bag. And I think that's why you're getting comments, well, good news is now good news. Good news is back to being bad news. I mean, I don't think that people really, I just think that there's a lot of confusion in the markets. And, that's okay.
Well, right now, a lot of people are saying that perhaps the Fed is less important. Maybe it's because it's the quiet periods. They've made themselves less important this week ahead of next week's Fed meeting. But it seems like they're kind of pricing out this idea that you could see a material increase in Fed funds rates going forward. We're kind of done. And now we have to actually see what the economy is doing in this sort of very confusing data dump that we keep getting.
No, I think that's right. I mean, I think the die is cast for the Fed to probably not do anything at the meeting that's upcoming. What they do going forward is remains to be seen. You saw, for example, with the RBA overnight. I mean, they had paused for a couple of months and now they're hiking again. So we'll see. I mean, I tend to think that the economy is far more resilient, as you know, than is appreciated, and that's going to mean that the Fed's ultimately going to have to do more than what's priced.
Do you think that we're poised for an earnings recession?
I mean, we're poised for one. We don't have one. I mean, I think that I think primarily that what's actually driving the market is earnings expectations, which have generally been improving over the last few weeks. I mean, one of the things I feel like I've learned so far this year is that when people talk about breadth and so, I mean, these are just coping mechanisms for why you've been underperforming. I mean, that's honestly what I believe. I mean, at the end of the day, the stock market's a function of what? Three things, right? It's the risk premium, it's earnings, and it's rates. And, rates are broadly unchanged and, year to date, and earnings are up. And that's why the market's up. Now, you can talk about, well, that's only for this company or that company. To me, it's irrelevant. I mean, my mother's really happy that Apple and Google and Microsoft are driving the gains in the market. I mean, it's like saying, like, oh my goodness, the stock market's being led by the companies that everybody owns.
All right. Well,
so
this is all very positive, and somebody who's coming on next has a different view on what's to come, particularly with earnings revisions. Taking a look just quickly at markets, you are seeing the Nasdaq, basically treading water, but slightly up in pre-market trading for the second. Basically flat on the day as people reassess in a very quiet day of both Fed speak, none of them, as well as economic data, none of them of import. We are also seeing crude prices lower by about 2.2% to $70.59, traded on the NYMEX, even after some of the OPEC plus cuts. Our next guest has been talking about an earnings recession. He's also been talking about how you could see a soft landing, and yet you could also see companies really have to ratchet back what their profits are going to be. It's Andrew Sheets, Chief Cross Asset Strategist at Morgan Stanley. Wonderful to have you on. Let's just start first in your thoughts on what Neil was talking about earlier.
Well, look, I do think that we should acknowledge this is an unusual time in markets. And again, I think in that opening clip showed, we have some of the highest core inflation since the 80s. We have the most inverted yield curve in the U.S. in 40 years, in Germany in 30 years. We have one of the lowest unemployment rates we've seen in the U.S. since the 1960s. So investors are dealing with some unusual data. Our view is that the economy is going to slow in the U.S. and Europe in the second half of the year, that the full effect of tightening has not yet been felt by the economy, but that tightening will continue to play out, and that even if you don't get a recession, the effect of slowing growth, especially the effect of slowing nominal GDP, is going to be bad for operating leverage, is going to put some pressure on earnings and mean that current expectations for earnings growth, we think, are still high for this year, which creates some near-term downside. Now, I think as you look further out, the picture looks a little bit better, but near-term, I think the market still has to get through a number of key challenges.
Andrew, you just put out a report talking about S&P earnings declining about 16% through the end of this year. What have been some of the responses that you've gotten? How have you explained why you see that, even though people have been revising upward some of those earnings expectations?
Yeah, so I think investors are skeptical of that sort of earnings move, which is understandable. It's a below consensus estimate, so the consensus is understandably higher. But also, I think you have investors who say, look, you've had economic data that's held up okay so far. You've had very good performance from some of the largest companies in the market, and so that is indicative of investors being more optimistic that earnings can be stronger going forward. And so I guess what we'd say to that is a couple of things. First, we do run kind of forward earnings indicators, forward earnings estimates, and those estimates, those models have been pretty good at predicting the events so far, and those models are saying that there's going to be more downside to consensus than what the consensus expects. I think if you look at some of those larger cap names that have been outperforming, their actual earnings growth has not been particularly strong. And even for the market overall, earnings growth is rapidly approaching kind of flat year over year. So this is a market that even in still a pretty strong nominal GDP environment is struggling to grow overall earnings. And we think that will get more difficult as you move ahead, as the market confronts the lagged effect of rate hikes and the lagged effect of some further tightening in bank credit conditions.
So Andrew, hi, this is Neil. Can you explain exactly how the long and variable lags work? I mean, because we've been hearing this argument now for, really since last year. And, I would expect to see significant slowing in credit areas of the credit-sensitive areas of the economy. But that's not what we're seeing. I mean, housing, autos, they look like they've been doing a little bit better. So can you explain, how that will actually work when it's been, several quarters now that they've been hiking and some of these credit-sensitive areas are actually picking up?
Yeah, so look, I think that's the challenge. The challenge with long and variable legs is that they're long and they're variable. And so if we think about our estimates for that, we think that rate hikes, you feel the full effect, maybe with a 12-month leg, which means that if we had rate hikes starting at the beginning of last year, you are only now starting to feel the full effect of those rate hikes in the U.S. and Europe. So we've not yet felt the full effect. The full effect is still to come. Moreover, if we think about the real policy rate, right, the interest rate relative to inflation, that is still going through some of its largest increases over the next several months as inflation finally falls and we think the Fed and the ECB keep rates high. So I think the first element is we haven't yet seen enough time to see the full effect of those rate hikes play through the economy, and we actually haven't seen the full effect of rates relative to inflation. Now, I think as it relates to the more credit-sensitive sectors of the economy, again, I think that's pretty fascinating because, again, as we've talked about at the opening, the equity market overall is very strong. The most credit-sensitive parts of the market, say the Russell 2000, small caps, more cyclical stocks, have really struggled. Commercial real estate, credit-sensitive, has really struggled. So I think we are starting to see some of the impact of that tighter policy play out. It hasn't played out at the overall market cap level, but I think it's playing out below the surface, and I think we still have some of that to come, which is a reason why we think growth decelerates further into the second half of the year.
Andrew, just quickly, how does this idea of a deceleration in earnings growth pair with a soft landing?
So I think they're actually quite compatible. Again, if we think about the types of forecasts that we're seeing, we saw a market and earnings really outperform the economy over the last 18 months. And I think one way of thinking about our estimates is that in the U.S., earnings in the market underperform the economy somewhat as you go forward. And especially because I think we think earnings are much more geared and much more linked to nominal GDP growth, which is decelerating sharply, maybe more so than real growth. Another part of this that's important is the labor market. I think if you have a soft landing, I think you're inherently talking about fewer job losses than you'd have in a recession. Well, fewer job losses is great for workers, but it might be more of a challenge for margins if the top line is slowing and costs aren't being pulled back in the same way.
Andrew Sheets of Morgan Stanley, thank you so much. Neil, what's your thought? Honestly, this is something that people are talking about, that you're going to get some sort of pullback and that you are seeing some of the sort of deceleration, particularly in the interest rate sensitive areas of commercial real estate, banks, others.
Sure. Well, I think a couple of things. I think number one, it's been a year, right? He said 12 months. It's been about 12 months. And what have we seen? Housing is accelerating. U.S. housing is accelerating. New home sales are surging, which means those are signed contracts, Lisa. Signed contracts. So that means that the home is sold, and that means that construction spending picks up. Now, with respect to long and variable lags, there are long and variable lags with fiscal policy also. The government, I think it cannot, you have to state this, the government did an unprecedented amount of stuff during the pandemic, okay? And when you give people money, that becomes their income. They go out and spend it. That becomes somebody else's income. You're still talking about state and local governments that are still sitting on pandemic relief money. You still have, I think I just saw Connecticut announce like a pretty significant income tax cut. And then you have, it's being drawn down, but you still have a decent pile of excess savings that's out there. So there are long and variable lags with fiscal policy as well, which is blunting some of the monetary policy effect.
And perhaps people have underestimated some of those long and variable lags pretty substantially, including myself, frankly, coming into this. I'll be honest, I didn't understand and appreciate just how significant that pile of cash, which we could talk about later. Right now, we are seeing some softness, although not necessarily in bonds. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The suspension of the federal debt ceiling is presenting a fresh challenge for U.S. banks. Lenders are struggling to hold on to deposits as customers opt for higher yielding alternatives. Now, money market mutual fund assets have ballooned to an all-time high. They've been quicker than banks to pass along to customers the higher interest rates supported by the Federal Reserve's policy actions over the past year. Ukraine says Russian forces have blown up a giant dam in the country's south. The blast has unleashed a deluge of water, putting 10 villages and parts of Kherson at risk of flooding. Residents are being told to prepare to evacuate. President Volodymyr Zelensky summoned an urgent meeting of Ukraine's National Security and Defense Council to discuss the attack. Morgan Stanley is planning to move to a new office in Singapore as it looks to expand its presence in Asia. Bloomberg has learned the company is in advanced talks to take over 5 floors of towers currently under construction. A boom in private banking, family offices, and other financial services during the pandemic has boosted demand for swanky offices in Singapore's business district. In China, hearings began today in a Tesla lawsuit against a protester who climbed on a car at the 2021 Shanghai Auto Show and shouted that a brake failure had almost killed her family. Now, the incident fueled online criticism of Tesla in China. Tesla denied the claim and filed a case against the protester, seeking $700,000 in damages. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iveson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg The Open with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
Mainland China is fully recovered, but again, driven largely by domestic Chinese travel. International airline seats into mainland China are only about 40% recovered to where they were pre-pandemic. But the balance of Asia Pacific, particularly markets like Japan, Thailand, are booming right now.
That was Tony Capuano, Marriott International President and CEO yesterday. China mainland has recovered fully. That is what he had to say, even though you do see right now an effort to stimulate that economy. In markets, you are seeing pretty much flat, not a lot of action, a quiet period for the Fed, as well as, of course, a relatively quiet period for economic data ahead of next week, which is pretty massive. Crude down more than 2%. A lot of people thinking this is on the heels of what we're seeing over in China. Tom and John both off today. Very happy to say we've got Neil Dutta of Renaissance Macro here alongside me for the hour, and really focused on China. I don't know how much that people can really account for it in their models, but how much do you think that's really the story behind oil that's really been driving it?
Well, it's hard to know because in some respects, I mean, demand has been holding up. If you look at consumer demand, I mean, right? I mean, at least, people are going to work more, traveling more, jet fuel demand is certainly higher, right? So I think the industrial side of China has been a disappointment, and I think that speaks to broader global manufacturing conditions, which have been sluggish. But at the same time, I think, at least as far as the U.S. is concerned, there's probably some room for improvement. Inventories are low everywhere, and at some point, if consumer demand is basically just holding steady, you're going to have to rebuild inventories eventually, right? And so what's interesting about what's going on in China is, as weak as it is, just look in China's neighborhood, right? There's a lot of strength there, right? Japan is on fire. India is on fire. I mean, it's like the gravity model of trade. So even though China is very weak, you have signs of improvement in other areas of the Asian Asia complex.
I'm so glad you mentioned that. Davian Sassauer dropped by of Bloomberg Intelligence. So happy to have you, as always, covering all things emerging markets from the credit sphere here at Bloomberg. And I'm curious, though, from that perspective, you are seeing that dynamism in other areas. And then add to that this idea that perhaps we'll get more stimulus from the Chinese Communist Party, as indicated overnight. How much are you looking at something that could surprise to the upside with respect to all of this activity?
Well, I think for every Japan, I'll show you Taiwan and South Korea and Asia. So, I think it's a tale of two stories. And, I think it's an Ed Beholder story because
I think near term, it's still just from a cyclical perspective, we have industries that have underhired relative to where they were pre-pandemic. This is the government, for example. This is education. This is healthcare. Some of these service industries that are still having trouble getting workers. So that is going to be ultimately a near-term tailwind for the labor market. But it also means that wage inflation is still probably going to be sticky. And so, this is going to, obviously lead into cyclical discussions around the Federal Reserve and how tight monetary policy has to be.
And this is going to be a big conversation for us coming up shortly. Tiffany, Livy, good to see you both.
Thanks,
Thank you. You mentioned the former Fed Vice Chair, Richard Clarida. He joins us next on this program. Your opening bell just around the corner.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Live from Newport Beach, California. Good morning. Good morning. I'm Jonathan Ferro. Going into the opening bell, equity markets shaping up as follows on the S&P 500. Futures just a little bit softer. No drama here. Slightly negative. We're down by not even 0.2%. We're negative 0.11% on the S&P. On the Nasdaq, negative about 0.2% as well. There's the opening bell. Switch up the board and get to the bond market. Some interesting moves there. Yields at the front end around 450 on a 10-year, about 370. Yields higher by a single basis point. In the FX market, getting used to life, below 107 on the euro, 106.80, negative by about 0.3%. All of this going into the Fed's next big meeting. Of the Fed, of course, going silent with its two-day policy meeting kicking off in just 1 week. Here's PIMCO CIO Dan Iverson earlier this hour.
Although we do expect in the base case for inflation to trend back down towards central bank targets, it too is likely to be much more volatile going forward. The balance of risks will be more symmetric going forward. So no longer do we live in a world where there's almost constant disinflationary pressure and a goal and desire from central banks to stimulate the economy to get back to target.
PIMCO weighing in on the Fed's road ahead, writing in their secular outlook, quote, "We don't expect developed market central banks to formally change their targets, but do expect those targeting 2% to be willing to tolerate 2-point-something inflation as part of what PIMCO is calling an opportunistic disinflation strategy." I'm pleased to say that joining us now is the PIMCO Global Economic Advisor, former Fed Vice Chair, good friend of ours, Richard Clarida. Good morning, Rich.
Great to be here, and thanks for coming out.
Good to see you. Thanks for having us.
Yeah.
Let's start with that. What on earth is opportunistic disinflation strategy? What is that?
Well, in some ways, John, it's back to the future. A lot of folks think of the early Greenspan years in the U.S. as opportunistic disinflation, raise rates to get inflation close to target, and then basically wait for the next downturn to get it all the way to target. And we actually think it's implicit. If you look at the Fed's SEP projections, they don't have inflation getting down to 2% for several more years, and yet they have themselves even cutting rates next year. So we think implicitly, not only the Fed, but other central banks will go down that road.
So when Chairman Powell last year talked about pain, Rich,
yeah,
do we not need that much pain then? Do we just push out the timeline?
Well, I think there will have to be an adjustment in the labor market even to get to 2-point-something. You see, the challenge now, John, is inflation's running at 4-point-something. So I think that pain in the labor market that Chair Powell referred to at Jackson Hole is going to be part of it to get inflation down to 2-point-something. But the next leg may have to wait till the next downturn.
Well, let's talk about the next downturn.
Yeah.
Where on earth is it? We've been talking about this for ages now. When Chairman Powell delivered that speech last year, even when you were at the Fed, I was thinking unemployment here, how's it going to handle this tightening cycle?
Yeah.
We're going from 0 to 5, and unemployment's still around 3.5.
Yeah.
We had Dan sit in your seat a little bit earlier and talk about the longer variable lags. He said potentially they're longer. Is that how you and the team are thinking about it now?
Well, yes. Remember, we actually had a sharp slowdown in growth last year. GDP growth downshifted from 6 to 1, and it will probably be in the 1s or even lower this year. So we've had the downshift in growth. Yes, John, the surprise is the U.S. labor market is very resilient. Typically, that slowdown in growth, you would see much more of a rise in unemployment. Our view continues to be that the lags will kick in. Labor market's typically a lagging indicator. But yes, it has been a surprise how resilient the labor market's been.
The Federal Reserve is talking about a skip, not a pause. How much effort goes into a shift in language like that? To not use the word pause and for everyone to coalesce around skip?
Well, a lot of effort, a lot of discussion among members of the so-called Troika, the chair, John Williams, and now Phil Jefferson. And then, of course, it's socialized in the broader committee. But suffice to say, there's a lot of wordsmithing that goes on behind the scenes.
The potential future, almost called him the future vice chair, but he is potentially going to be that. Governor Jefferson, talk to me about how pivotal that address from him was last week. How important was that?
It was important. First of all, it was an excellent speech, and really in Phil's voice. I've known Phil for 30 years. We were colleagues at Columbia. But it did something very important, which is that the chair had tried to put his stamp on communication at an event at the Fed two or 3 weeks ago. And then, as is often the case, there's a lot of chatter from different Reserve Bank presidents and governors. And so market pricing was really all over the map. Do they cut? Do they hike? Hike 3 times? Cut 3 times? And so Governor Jefferson came out and gave a very focused speech illustrating that a skip, if the committee chooses to skip, will not indicate that they're done. But they do need to respect the lags and the additional tightening we're likely to get from banking dislocation. So it, in essence, reinforced the message that the chair had delivered weeks before, and I think that served a very useful purpose because it shows that that's what the chair is thinking going into the next meeting.
Do you think this is it, the peak of interest rates of the Fed? Is that the view for you and the team?
Well, is it the peak? I think that the data's been coming in a bit stronger, and if anything, even some of the more dovish members of the committee have sounded a bit hawkish. So we could get an additional hike or two in this cycle. I think it's a closer call than I would have thought several months ago. I will say, I still think that the reasoning that the chair put forward, which is that we've had this dislocation in banking, 2 of the biggest bank failures in U.S. history. Right now markets have sort of moved on to the next thing, but some of those challenges remain. And so I think that's going to come back into the discussion at some point as well.
There were some thoughts about rate cuts. We priced them in.
Yeah.
We priced them out. Just how high is the bar for rate cuts?
John, I think the bar for rate cuts the rest of this calendar year is very high. Not only on economic grounds, but the communication's been very consistent from the most dovish to the most hawkish member. Every member of that committee has said, look, we're not going to do the heavy lifting to get rates in restrictive territory and then start to cut them. So I think the bar to cutting this year is very high because remember, the Fed has penciled into its projections a pretty sharp slowdown in the labor market. They have the unemployment rate going up to 4.5% by the end of the year without any cuts. So I do think if there are cuts, it's really a 2024 story. But yeah, I think the bar's high.
Let's pair this conversation with the secular outlook.
Yeah.
What are they going back to if they do begin to cut? There's been a big conversation about that. We're not going back to zero. I think we've both heard that conversation a million times. What would we go back to?
Well, we did a lot of discussion and thinking on this, and of course in 2014 we rolled out at our forum the new neutral idea, which was that the Fed funds range would end up neutral somewhere in 2 to 3%. And this year we reaffirmed that view. So we do think most of the factors that kept policy rates, again, these are the policy rates when you're at full employment and low inflation. We think there's more upside risk to the inflation outlook than the real rate outlook. And so our baseline view is that Jay Powell and Christine Lagarde and Andrew Bailey and the central bankers will do more or less what it takes to keep inflation expectations anchored. But if there is a risk to the inflation outlook, it's somewhat to the upside. So we do think that once the inflation rate has come down close to where the Fed wants it, once the economy's adjusted, we think, and apparently they still think through the dots, rates are getting down into the 2s.
You share that view?
I do share that view. I think what could be different this time, the saying this time is different. I think what could be different this time is we may have policy rates in the 2s, but we may have higher bond yields. The Treasury issued a lot of debt to support the fiscal policy during the pandemic. We now have a debt to GDP ratio back to where it was in World War II, 100% of GDP. It wasn't that long ago that folks like Ken Rogoff and others were saying once you get above 100, it fundamentally changes your economy. So we do think that the Fed will probably be doing less QE in the future, what we've called QE fatigue. And we think there's a limit to how much Treasury debt investors will hold without getting compensated. So we could see a world of steeper yield curves. Right now they're inverted, but they could re-steepen.
Okay, so basically the Federal Reserve is at 2, and you're thinking about what further out the yield curve?
10-year Treasuries ultimately somewhere in the 3s, depending upon how we get to 2 and also how credible the Fed is on inflation.
They're coming out with a ton of T-bill issuance at the Treasury, hundreds of billions.
Yeah.
Now, if you're a bear, you're bearish about it, and if you're a bull, you don't really care. Give us the reality check. What do you think that ultimately means? Hundreds of billions of dollars of T-bills coming into the market all at once. How does that spill over?
Well, it's interesting, John, because a lot of the discussion until recently has been there's been a shortage of T-bills. The Treasury's doing this, of course, because we got the debt ceiling bill finally passed, and they want to replenish their checking account at the Fed, what's called the Treasury General Account. So they'll do that by issuing T-bills. That will put some upward pressure on front-end rates. Not really an issue for the Fed in terms of maintaining its policy rate, but a potential issue for the liquidity of the banking system. Because when the Treasury issues T-bills to private investors, if private investors are not money market funds, those reserves drain the system. It could tighten liquidity in the banking system. If they come from money market funds, which are investing now at the Fed, it may not. So I think there's more than the usual amount of uncertainty about how bank liquidity evolves over the next 6 months with these T-bill sales.
Do you think that's another reason to skip June, to wait?
I do not think that's another reason to skip June. I think that if they skip June, which it looks like they will, it will be basically based on the macro and inflation discussion now.
I want to finish on inflation. Just a final question. In this piece, 2 point something. That's your world. I can hear your language in there. If we set a new inflation target today, not that they're going to, you push back against that, but if we did, would it still be 2%?
Well, the way I like to put it is that if you rewind the tape to 30 years ago and central banks had sort of agreed on 3, I don't think anything would be different now. But there is what people call path dependence in policy. And having committed to doing 2, I think it would be very costly. And I think they'll shy away from formally changing the target.
Interesting. Rich, good to see you. Great to catch up as always.
John.
Fantastic. Richard Clarida there, the former Fed Vice Chair. Coming up, time to talk markets. We're speaking with PIMCO's Mark Kiesel and Sonali Peer. That conversation just around the corner from a beautiful Newport Beach, California, at PIMCO's global headquarters. This is Bloomberg.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From business's most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
We actually had a sharp slowdown in growth last year. GDP growth downshifted from 6 to 1, and it will probably be in the ones or even lower this year. So we've had the downshift in growth. Yes, John, the surprise is the U.S. labor market is very resilient. Typically, that slowdown in growth, you would see much more of a rise in unemployment. Our view continues to be that the lags will kick in. Labor market's typically a lagging indicator, but yes, it has been a surprise how resilient the labor market's been.
That was PIMCO's global economic advisor and former Fed Vice Chair Richard Clarida on the labour market. Shifting to credit markets, PIMCO writing in the secular outlook this morning, high-quality bonds may offer long-term equity-like return potential with significantly less volatility and more downside protection than equities. We believe fixed income markets are pricing in expected volatility in ways that equity markets are not. PIMCO Global Credit CIO Mark Kiesel and multi-sector credit portfolio manager Sonali Peer join us now for more. Guys, great to catch up with you both. Sonali, I wanted to start with you and just talk about the maths of this, just the basic bond maths and why you guys believe that this year is going to be nothing like last year.
Yeah, certainly. The starting higher level of yields this year really provide a cushion. So even if we were to have some spread widening, we do see very high potential for positive returns. We've built in some lower price as well, so there's some downside cushion and some upside convexity in the bond market. Really, but the bonds have almost never looked better, given the starting valuations.
Mark, I said this to Dan earlier this morning. It feels like you and the team are throwing cold water at equities this morning. Why is that?
Well, we think you can get equity-like returns in bonds. The long-term equity return over 50 years is 6 to 7%. We think we can get an equity return. We haven't seen this return potential in bonds in 14 years. When you look at nominal and real yields, high-quality bonds can deliver equity returns with half to third the volatility. So this is as exciting as we've seen it in almost 14 years, and we don't think these yields will be here a year from now.
Is there a maturity wall that I need to worry about?
Yeah, you know, we're actually looking at markets where we had such robust open capital markets in the back half of 2020 and in 2021 that companies really termed out their debt. You know, looking at even high yield markets, we have less than 20% coming due over the next 3 years, which will mean that we have a lower default rate than in previous recessions, albeit higher from here.
Two sectors I think everyone wants to hear from you and the team on: banks, real estate. Can I start with residential? Mark, we've had this conversation before. Pre-crisis, pre-GFC, you called the top. Coming out of it, you called the bottom. Last year, you kind of almost called the top again. What's happening?
Well, I think, Jonathan, what's happening is that the consumer is sitting there with 3.5% unemployment, and also you've underbuilt the housing market for a decade. What happened back in 2006 is we were oversupplied by 2 to 3 million units. And then basically what happened is no one built houses for a decade, and so we undersupplied the market by 3 to 4 million units. So the market's really being held up by very low supply. But on the demand side, these higher interest rates are going to affect people for new purchases. So the bottom line is that housing's been more resilient because of constrained supply.
Is that a story that you're de-risking around in anticipation of trouble ahead? Is that a focus for you?
What we're doing is we're focused on the sectors where we think there's going to be significant secular and cyclical growth. On the secular side, you have things like LNG and defense, where you've got long-term tailwinds. On the cyclical side, you've got this move from goods spending to services. There's still huge pent-up demand for travel and tourism, particularly on business travel. So things like airlines, hotels, gaming, we're very much invested in what we call fun. Fun is returning. People have been underinvested in fun, and so that's where PIMCO's moved.
As some of this doesn't feel like fun, does it feel like fun to you?
You know, higher yields and more dispersion gives us a lot more opportunity to invest.
The banking sector hasn't been fun. One thing that I've heard repeatedly, and a lot of people have heard repeatedly on programs like this one, is I want to be up in quality. I want investment grade. And then I can show you a failed bank that was IG just a month before it failed. What's gone wrong in that sector? And what have you learned from what's developed over the last few months?
Yeah, I think it's very difficult for banks to know how long their deposit base is there, right? So in terms of understanding how much we've repriced in terms of interest rates, that steep repricing means that they needed to have managed the duration of it, right? So meaning the assets and the management liability aspect. That's been one issue, and then really deposits are the lifeline for banks. So in terms of, you know, from here, how we evaluate banks is we continue to look at these things, what they're invested in, you know, what their deposit base, how correlated it is, and look for opportunities really within that, right? Not all of these banks are in similar situations, and in fact, I would very clearly make this distinction that this is not the great financial crisis. This is more of an issue of, you know, the broader takeaway is the tightening financial conditions as opposed to the few banks that have been in a very difficult situation.
We know the regionals as a whole have a big role to play in commercial real estate, so let's tie together two themes, real estate and the banks. Mark, it's one of those things that we hear so much about. In fact, it's the number one question that people will come up to me and ask me, what are people telling you about commercial real estate? And then you get these calm, cool heads that come on programs like this and say, there's nothing to worry about, there's nothing to see. Is there anything to worry about? Is there anything to see?
Well, I think, John, just like all markets, there's going to be winners and losers, and credit is tightening most for the commercial real estate sector. You're seeing that in the regional bank, equity performance, the commercial REITs, et cetera. So this is actually going to end up in opportunities down the road for our private credit business. So we're actually very excited about it. The issue is the public markets have marked to market very quickly, so you've seen significant underperformance in those areas. The private markets have yet to mark to market, so we actually see this as a longer-term opportunity for PIMCO.
Don't you think the repricing that's yet to come in private markets is going to have some kind of negative spillover for what develops in public markets? The losses that people might have to absorb there?
Yeah, it will, and that's why when you look at where we have been focused, we've been focused on these sectors where you've got significant improvement in fundamentals in the years ahead. I can show you many sectors where even if we have a mild recession in the United States, credit fundamentals will improve independent of the U.S. business cycle.
Name one.
LNG. LNG is on long-term contracts, and that sector will look more healthy a year from now than it does today, even if we have a recession.
We'll be sitting here in a year from now, and we can talk about it. Mark Kiesel, Sonali Peer, to the two of you, thank you. Thank you very much. Coming up, the conversation will continue. We're going to round out this hour with the man himself, the boss, the CEO, Manny Roman. Another exclusive conversation you will only see here on Bloomberg TV.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Over the next 5 or even 10 years, we're going to be in a very, very different world than the world we were in pre-COVID, where again, these types of risks that were well contained for an extended period of time and led to a certain type of risk-seeking behavior by end investors is likely behind us. And we're going to be in a more uncertain world, a less synchronized world, and a world that's going to create, a tremendous amount of opportunity to take advantage of shifting opportunities.
Just a brilliant collection of conversations this morning through the hour from a beautiful Newport Beach, California. I'm Jonathan Ferro. PIMCO publishing its secular outlook, The Aftershock Economy, writing, quote, "We see a window to step in as a senior lender in areas once occupied by regional banks, such as consumer lending, mortgage credit, and various forms of asset-based finance." I'm very pleased to say that we can have that conversation now with the man himself, the boss, PIMCO CEO, Manny Roman. Manny, good morning to you, and thanks for having us.
Good morning, Jonathan. Nice to see you.
That quote feels like your kind of language. We're going to step in. My first thought when I read that was, why don't you just buy a bank? There's many banks on sale right now. Why don't you just buy a bank?
Well, I think there are going to be many assets to buy. And maybe the best way I have to describe it is banks are going to be tight for capital. And when they're tight for capital, they have two ways of solving the problem. They can either raise more capital or they can sell assets. And the most likely scenario is there will be assets to sell in area where we have a big footprint. Mortgages, commercial real estate, bonds, municipal bonds. Dan said that earlier today that he was very keen on mortgages. There'll be mortgages to sell, and we'll be there to step in and try to buy them.
Are you looking at buying a franchise to do that, or is that just something that happens organically?
This is something that we've built over the past 20 years, and there's good news and bad news when you have a tougher economic cycle. I think the better news is that the expected return goes up and there are significant block of assets to sell. It could be, for example, equipment loans. One of the banks who was very big in equipment loans is out of business. All of a sudden, there's going to be a lot for us to do.
I hear this from other people too. I hear Apollo say banks are going to step back, we're going to step back in. How competitive is this going to be? Can you give me some size and scope and how big the pie is going to be?
It is going to be competitive because the seller has a fiduciary duty, and there will be enough for some of us to do a lot and put money to work and be patient and wait for the right opportunity to do so. And I think the cycle is usually long, and so there's no rush to put money to work. There is a very disciplined and systematic way to look at the opportunity, and some will look better than the other. It may very well be that the single best asset turns out to be real estate where we have a big footprint, or it may very well be that it turns out to be commercial real estate and mortgages and this whole segment. And
commercial real estate is something you've brought up, and I've heard it from Dan. I spoke to Mark about it just moments ago. Should I be worried about commercial real estate? Can you just take me into the halls of this place, this building? Have you all sat around a table, gone through every single portfolio and thought about what you don't want exposure to right now related to this one particular sector?
Well, I think we have, and I think we've seen the playbook before, and it is everything else being equal, a slow cycle. So the banks will look at their portfolio and slowly but surely mark their books. I think you have a microstructure of the commercial real estate market, which is quite different, depending on the city, depending on the places. Some places are clearly tested. Some of them are doing just fine. I mean, you can look at Austin, for example. You're hard-pressed to find an empty office in Austin. And the overall trend is going to be that people somehow come back to work one way or the other. But there's a transition period where, for sure, there will be distressed seller and people who have the wrong financing. And I think the financing part is really, really important because it's one of the segments where we're very involved, and people have borrowed short-term in the past with very low rates. All of a sudden, the financing is expiring, spreads are higher, and of course, rates are much higher, and so they will need to address the situation either by selling or by refunding at more attractive terms for us.
Clearly, this business is going to change compared to what it was several decades ago. We've had a multi-decade bond bull market. Most people assume that's now over based on the last 12 months. Can you tell me how this business will be different with that in mind? What you need to position for now versus what this firm was positioned for in the previous several decades?
Well, the very big change, and Dan mentioned this before, is generative AI and how technology can change our business. And think, for example, about the real estate market. We can hire 100 people to go from city to city and kind of look at every single lease or every single property, or we can use technology to give us a better grasp of where the alpha is and where we think the opportunity is. When we think about communication with client, we can invest significantly in generative AI and actually give a better risk report, better customized report to clients, and so on and so forth. And I think it's incredibly exciting. I see the work that we do with OpenAI and Microsoft as important as the birth of the internet. I mean, it's that
powerful?
It is that powerful, and it will change your job also.
Change your job too, potentially.
Yeah, no, of course. I mean, in a good way. I think it will make us more productive, and I think that's a really, really good thing.
Is that a challenge to your secular outlook?
I think on a super
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a